Okay, we're live. Hello, hello, people. Sorry, we're late upon late today. Pretty much nothing is going as planned today at all. Pretty much. Not only did I reschedule my stream for later in the afternoon rather than in the morning, but also then I'm late to even the time that I set in the afternoon. I woke up kind of sick today, and I'm still kind of sick, but I still want to do this regardless. I'm home from work anyway, so I might as well be doing something. I'm definitely going to try and not really talk much, other than maybe like my summary at the end. So we're just going to listen to earnings calls pretty much while I do this. But yeah, go get your vaccine, even though it does come with side effects, which is why I'm sick. But I imagine this is better than getting the big bad coof. So go get it. The vaccine, not the coof. Yeah, so today we're gonna do our evaluation of Discovery, as I've sort of been promising for a week or two now. After we did our updated check on at&t, looking to see what it would look like after they do the spinoff. And so now we're going to do Discovery, which we're going to do what Discovery looks like without the spinoff, so that we see what it looked like prior to that. And then at some point we're going to do a second stream to see what Warner Bros. Discovery, which is what the combined company is going to be called, will look like in a pro forma form. Which, like I said, I come at this from an at&t shareholder's perspective. So, and I've already sort of proven for my own sake, from my own perspective, that at&t's value is maintained by this. In fact, it's improved a little bit. Not in a huge way, but it is improved a little bit, which means that since you don't lose money from the at&t perspective, it makes the collection of the merger shares of Warner Bros. Discovery essentially be free money, as I'm calling it. And so as a result of that, I'm pretty pleased with that. But I'm also taking a look at what Discovery looks like by itself pre-merger, and then we're going to do the pro forma evaluation of Warner Bros. Discovery, so that we can take a look from the Discovery shareholder perspective to see whether or not it's a good deal for them or not. And if it's a good enough deal from their perspective, well, I might pick up some shares of Discovery pre-merger, even, possibly. It would have to be extremely good from their perspective, and it would probably be a much smaller position than my at&t position, but it's reasonable to take it from both sides, so to speak, to sort of average out the difference between the two if there is a large enough value spread, because then it sort of protects against possible mistakes I could be making in either direction. But we'll take a look and we'll see what that we come up with in the first place. So yeah, probably going to be going at this a little bit slower than normal, because like I said, I feel like crap, so that is what it is. I'm eating while I do this, but yeah, if you enjoy content like this, or you've been watching my streams or any of my other videos for any sort of length of time, please subscribe to the channel, like the video, leave comments, all that stuff. Very, very much appreciated. Share things around, all that. Give me a moment to get everything in place, and we'll get those earnings calls playing so that you at least have something to listen to, like I said, because my throat and my voice feel absolutely terrible, so I'm not really going to talk much until the very, very end. You can do the numbers, and you guys can watch. All right. On here. I don't know why, but my connection's being a little weird. All right. What is today? Today's the 7th. So okay, their annual meeting of stockholders is actually in 3 days. Blank page here. That's very nice. Thank you, chill.
Ladies and gentlemen, thank you for standing by, and welcome to the Discovery, Inc. fourth quarter and full year 2020 earnings conference call. At this time, all participants' lines are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star on one of your telephones. Please be advised that today's conference may be recorded. If you require any further assistance, please press star and 0. I would now like to hand the conference over to your speaker today, Mr. Andrew Slavin, Executive Vice President, Global Investor Strategy. Sir, you may begin.
Good morning, everyone. Thank you for joining us for Discovery's Q4 earnings call. Joining me today are David Zaslav, President and Chief Executive Officer, Gunnar Wiedenfels, Chief Financial Officer, and JB Perrette, President and CEO of Discovery Networks International. You should have received our earnings release, but if not, feel free to access it on our website at www.corporate.discovery.com. On today's call, we will begin with some opening comments from David and Gunnar, and then we will open the call to take questions. Before we start, I'd like to remind you that comments today regarding the company's future business plans, prospects, and financial performance are forward-looking statements that we make pursuant to the safe harbor provisions of the Private Securities Litigation Reform Act of 1995. These statements are made based on management's current knowledge and assumptions about future events, and they involve risks and uncertainties that could cause actual results to differ materially from our expectations. In providing projections and other forward-looking statements, the company disclaims any intent or obligation to update them. For additional information on important factors that could affect these expectations, please see our Form 10-K.
The audio is hopefully
made with
in a regional place.
And with that, I'm going to turn the call over to David.
Good morning, and I hope everyone is having a great start to 2021. And we thank you all for joining us here today. This is a dynamic time for Discovery. The past year has been one of change, challenge, and opportunity, during which we've shown incredible resilience, creativity, and focus as one global team. From navigating the pandemic to generating meaningful momentum towards our strategic pivot, Discovery has responded with drive and determination. This is also a unique time for us, because as we are working hard to solidify our core linear business, in which we continue to meaningfully outperform, we are repositioning the company against a massive new opportunity in streaming, where we already see very positive signals and signs that, taken together with the durability of our core business, will nicely position the company for sustainable long-term growth. Sustainable long-term growth. That is our mission, and we are laser focused on delivering. We finished 2020 with strong operating momentum and great command and control across our global businesses, delivering top-line improvements across virtually every key operating metric since the pandemic hit, while maintaining strong discipline over our expenses, without sacrificing quality or missing a beat in our creative execution. We were even able to return nearly $1 billion of capital to shareholders in equity buybacks. We learned a lot as we managed through 2020, and our tenacity and agility, which is truly at the heart of Discovery, took center stage. The impact of our content, either as measured in terms of global share growth or simply in the way people sought us out for comfort and nourishment during a difficult time, became more relevant and more of the moment like never before. We encouraged our talent to bring us into their kitchens, gardens, living rooms, with iPhones and GoPros, and it was a game changer. When most of our peers showed older repeats, we became closer to real and more authentic on air. And that provided a great boost of adrenaline across the company and our talent partners, and refined our IP all around the globe. And I'm even more excited about 2021 and the meaningful progress we are making in our strategic pivot, while at the same time working hard to support our core linear networks business and reinforcing its importance as a critical part of our total consumer offering. Discovery Plus is off to a fantastic start, and we couldn't be more encouraged by all the early metrics. After 7 weeks since launching here in the US, we have over 11 million paying direct-to-consumer subscribers across our entire portfolio, and we will hit 12 million by the the end of this month of February. An increase of 7 million net adds as compared to 5 million subs we reported in December. The vast majority of this increase is attributable to Discovery Plus, and substantially more than half of the 7 million ads are paying Discovery Plus subscribers in the United States. And we are really just getting started internationally, as this comes without adding any new markets other than our previous Dplay markets that we rebranded to Discovery Plus. For example, we relaunched Italy just a few weeks ago, and the UK in Q4 2020, both of which are off to a strong start. Given our ownership and control of all of our content, our increasingly relevant content, expect us to light up markets globally over the next 18 months or so. And in many key markets, we intend to partner with key distributors, such as we did with Vodafone and Sky. These discussions are active and going very well. And our existing momentum is helping facilitate these conversations as distributors remain keen to provide incremental value to their subscribers as a means of leveraging their pipe and decommoditizing their offering. In both regards, we are a fantastic partner. We bring strong global and local IP at really superior value. We are by far the best value to consumers and distributors in a global SVOD service in the marketplace, helped by our financial model and the fact that we own all of our global IP. The rollout of the Discovery Plus platform has been nearly flawless, without any technological disruptions or outages. The Discovery Plus product launched with all major platforms and devices: Roku, Fire, Android, Apple, Samsung, and there's more to come. And we came to market with an ambitious slate of over 1,000 original hours over the coming year. Stay tuned for further delivery partnerships, such as partnerships with cable operators and other connected TV platforms, all of which move us further along as our goal to be among the most widely available platforms to consumers everywhere on the globe, with easy access to consumers in every language. Importantly, consumers love the Discovery Plus product, and it shows with all key operating metrics pointing in the right direction. We're seeing very high consumer engagement and high video starts. An incredible 93% of our entire 55,000 episode library has been watched, indicating a very healthy long tail of content that has immense value to consumers now that we've made it available. We're also seeing high retention over the first 60 days, as well as strong monetization that is already translating into incremental value. Gunnar will provide some additional details and financial context, but in short, stronger operating performance across the board is contributing to a better than expected financial profile and accelerating next-gen revenue growth in Q1 and thereafter. Very healthy roll to pay and initial signs of lower churn than we initially modeled will drive accelerating sequential domestic affiliate fee growth, even over Q4's impressive 5% growth rate as we begin to layer Discovery Plus on top of our core base, resulting in at least high single, if not double-digit affiliate growth in the following quarter. We now have over 100 advertisers and brands on the platform in the US, and we expect to double that by the end of Q2. Our team is working hard at implementing our feature-rich product roadmap. We are now offering contextual keyword targeting, and interactive ads will roll out by the end of Q1, with pause and binge ads scheduled for Q2. And as the subscriber base further scales, the benefits of combining the intelligence and data mining capabilities on our end, together with advertiser first-party data, will represent a significant opportunity for us and our advertising partners. We are already an industry leader when it comes to time spent with our linear portfolio. Yet watch time on Discovery Plus in the U.S. is nearly twice that. This naturally has been extremely well received by our advertising and brand partners, which, coupled with initial signs that Discovery Plus extends effective reach to non-pay TV viewers, gives us even more conviction and confidence in the long-term Arpu trajectory. In fact, our ad-light Arpu in the U.S. is already above linear, and we are just getting started. As we scale and usage continues, we are confident our Arpu will grow meaningfully. Internationally, JB and our product and engineering teams are hard at work transitioning our former Dplay and Eurosport Player platforms to our new Discovery Plus global product in time for the Tokyo Olympics and the Beijing Games not long thereafter. Discovery Plus will be the streaming home of the games in Europe with access to every minute, every medal, and every hero, live and on demand. Having this product integration completed will enable us to then execute more of our ambitious international expansion plan in the back half of the year, as I previously noted. Taken together, Discovery Plus has successfully launched as a truly differentiated product with a fantastic consumer experience, best-in-class product reviews, and terrific word of mouth.
There we go.
Which is ultimately the most effective form of marketing. We are being educated every day on what's working and what's not, and are responding rapidly to iterate and experiment. We are utilizing all of our levers to effectively and efficiently acquire and retain subscribers, including a growing list of global partnerships with many of the world's leading distributors, an exciting pipeline of originals that we believe will surprise and delight consumers, and a brand campaign that is unrivaled in our history. The team is doing a lot right, and we are seeing the payoff in subscriber additions and engagement, for which we believe there is no better use of our capital and resources than to continue to support these efforts as a means to drive shareholder value. With the very healthy metrics we've seen thus far, scaling our Discovery Plus subscriber base as quickly as possible is the best use of our free cash flow as we eye sustainable long-term financial growth for the overall Discovery company. Our first and foremost priority has always been and will always be to reinvest in our business to drive organic growth. Our powerful launch serves as a strong confirmation of what we have been hard at work building over the last many years, and that which the acquisition of Scripps helped to accelerate. We have spent years amassing and cultivating the most popular real-life entertainment content, brands, and personalities, all with a focus on nurturing and delighting our fans across multiple video ecosystems, pay, free, and streaming. It's having a real impact, and an impact we expect will continue to grow. Investing in high-quality premium programming across the entirety of our platforms has always been our North Star. In fact, at a time when many of our peers are taking their foot off the gas, we expect to increase our spend on fresh content to support our linear networks this year. This further reinforces our strong value proposition to our distribution partners. Indeed, we believe the basic pay TV bundle is integral and relevant and offers an incredible value proposition to an important and large segment of consumers. Discovery is a true global IP company in every sense of the word, one of the very few true global IP companies. And growing our vault of great stories and series has laid the groundwork for the critical next steps we are taking, evolving from a pay TV and free-to-air company into a scaling global streaming player. Discovery's mission is to play hard in traditional free-to-air and cable with fantastic margins and free cash flow, and play harder in direct-to-consumer while we are uniquely positioned to achieve long-term sustainable growth. With that, let me now turn it over to Gunnar.
Thank you, David, and good morning, everyone. Echoing David's comments, 2020 was indeed a year that presented its fair share of challenges. Likewise, it stress-tested our company in unprecedented ways. Looking back, I am extraordinarily proud of both how our team reacted to such disruption, as well as how we proactively leaned forward into our strategic pivot. I do believe we accomplished a tremendous amount in 2020, operationally, financially, managerially, and strategically.
That's a whole lot of very individualized debt issuances.
More detail shortly. But first, to briefly recap Q4, a very solid set of results across the board. Starting with U.S. networks, advertising revenues were consistent with the prior year, supported by an ad market that continued to show signs of recovery, as well as a general tightening of the marketplace due to political
25.
Following a
Holy
generally
crap.
advantageous upfront market, we saw extremely healthy scatter CPMs up in the high 20% range versus upfront, and up high single digits year over year. And that trend has continued into the first quarter with scatter CPMs up around 40% versus upfront and up mid-teens year over year. While on balance, demand has returned in most categories to year-ago levels, a number of verticals such as travel, movie studios, and restaurant chains still remain challenged. U.S. distribution revenues increased at a very solid 5% year over year during the fourth quarter, as pricing more than offset subscriber declines, supporting a nice acceleration from Q3. We benefited from a combination of a slower pace of subscriber declines, the impact from recent renewals, and our continued strength across virtual MVPDs. Subscribers to our core fully distributed networks declined by 3%, while our total portfolio subscribers declined by 5%. Now turning to the international networks for the fourth quarter, which I will discuss on a constant currency basis. Advertising revenues decreased 1% year over year, led primarily by continuing sequential improvements across many of our key markets, and some, like the UK, Germany, Poland, and certain APAC countries finished the fourth quarter with positive growth, while other markets, such as across Latin America, are still exhibiting COVID-related weakness. Distribution revenues decreased 4% year over year. We continue to see modest subscriber churn from more economically challenged countries in Latin America. Furthermore, COVID-related disruption in the sports schedule throughout 2020 continued to impact our Eurosport performance in the fourth quarter, as well as continued headwinds in overall pricing, primarily in EMEA. Total operating expenses were up 5% during the quarter. Cost of revenues were up 6%, largely due to the condensing of the sports schedule into the back half of the year and continued rampant content investments to support our next generation initiatives. SG&A increased 3% as we invested in marketing and branding promotion ahead of the launch of Discovery+, as well as personnel and technology spending to support our initiatives. And as we guided, we finished 2020 with total operating expenses flat year over year ex-FX, as we reallocated spend, and we continue to target a low to mid-single-digit percentage reduction in our core linear businesses as we support our next-gen endeavors. Turning to free cash flow, we finished 2020 with over $2.3 billion in free cash flow, a 56% AOIBDA to free cash flow conversion rate. A great finish considering the volatility and headwinds we faced this past year, and still do to an extent from disruptions related to COVID, while at the same time having absorbed a meaningful step up in D2C investment. And as we guided to at our December Investor Day, we continue to expect to convert at least 50% of our AOIBDA to free cash flow this year. Now turning to Discovery+, which is off to a very impressive start. And though it's early in our launch and global rollout, we are very pleased with all of the early metrics. First, we have now surpassed 11 million total global paying direct-to-consumer subscribers in less than 60 days since the launch in the US, the majority of which are attributed to Discovery+, and more than half of the subscriber additions were in the US. And as David mentioned, we will hit 12 million global paying subscribers by the end of the month. Second, importantly, both roll-to-pay and churn have been better than planned, and while early, these represent critical variables in our model. Third, engagement, as measured by average watch time per active viewer, has been robust and already significantly ahead of linear. Fourth, this engagement, along with advertisers and brands eager to embrace our subscriber base, is driving higher CPMs. It is worth pointing out the value our advertisers see in the portion of our subscriber base that are not currently paid TV subscribers, delivering much-needed incremental reach to the video advertising ecosystem. This, as well, has contributed to very healthy ad monetization that is already well ahead of plan. Number 5, this has led to Arpu for our AdLight product that has already surpassed average linear Arpu. And we see further upside as we drive scale in subscribers, a key tenet we laid out in early December. Number 6, early signs of churn are within our expectations, if not better, which taken together with the monetization framework I provided are contributing to a higher implied customer lifetime value than our initial modeling. Number 7, finally, subscriber acquisition costs have so far come in very favorably, especially compared with the evolving customer lifetime value. Consequently, taking these early data points together, we see both a very strong start to next-gen revenue growth in 2021, with Q1 poised to grow around 50% with meaningful acceleration in the quarters thereafter, and a much more attractive investment opportunity around subscriber growth. Given Discovery Plus net adds, the majority of which are in the US, we should also...
I always hate when I have to fill in like 20 lines for the individualized debt maturities, because it's so easy to screw that up writing that out.
High single digits, if not low double digits year over year, a meaningful acceleration from the last quarters. I must say I like the sound of that. Candidly, it's been a while since we have had a growth profile like that for domestic distribution. While the advertisers' embrace for Discovery Plus has been great and will help to support our overall advertising profile as we scale, we expect a modest sequential headwind to Q1 US advertising revenues, in part related to macro factors, as well as the launch of Discovery Plus, where we are leaning in with more of our inventory to promote the service. We have embarked on an aggressive branding and performance marketing campaign, and we are seeing efficient SAC. As I noted earlier, with SAC so favorable to CLV, we expect to lean into this opportunity in a greater way, and we now expect to see greater incremental next-generation losses than the $200 to $300 million initially described. This could potentially be a couple $100 million more, but it's too early to pinpoint a finer range. I am very confident to categorize this as success-based spending. We do, however, still see 2021 as representing the peak year for losses from our investment initiatives. Which brings us to capital allocation, where our first priority is to reinvest in our business to drive long-term growth and shareholder value. And for the near term, the most productive use of our free cash flow will be to drive Discovery Plus subscribers. Thus, you should not expect us to be in the market buying back our equity in the near term, though as we gain additional clarity around requisite spend to support our rollout, we will of course revisit the buyback. We finished 2020 at approximately 3.3 times net leverage. Through 2021, due to timing factors...
Thank you whoever liked it already. I see I have 2 viewers. Please subscribe to the channel if you're not subscribed.
We're comfortable with this outlook, particularly as we remain committed to our investment grade rating. Now, turning to a couple of housekeeping...
Maybe doing this later in the day has its perks. I normally do it in the morning, which is just because that's usually when I have time, because I normally have a day job. Like I said, I'm like kind of sick today, so I'm taking today off, but maybe it's better to do it in the afternoon when people are up.
$70 million year-over-year impact on revenues and a neutral year-over-year impact on EBITDA. In closing, we are incredibly excited by the initial success of Discovery Plus and remain as enthusiastic as ever as we position the company for long-term sustained growth. Clearly, lots more to accomplish given only a few months in, and we look forward to updating you on our progress.
Wait, where did I miss one?
Thank you again for joining us. With that, I'd like to turn it
Or did I
over
just
to
count
the
wrong?
operator
I could have just
for the
counted wrong.
portion of the call, and
I do
David,
that sometimes.
JP, and I will be happy to take your questions.
Thank you. Ladies and gentlemen, to ask a question, please press star and then
Oh,
one
see,
on
I
your
counted
touchtone
that one. That's
telephone.
why.
If your question has been
Okay,
answered
so there
or
is
you wish to
just
remove
one too many
yourself
lines.
from the queue, please press the pound key. Once again, to ask a question, please press star and then one at this time. And our first question comes from Robert
That's fine,
Fishman
simple enough
from
fix.
MoffettNathanson. Your line is open.
Hi, good morning. Can you be a little bit more specific about the cadence of the international rollout for Discovery Plus in the next few months? And have your partners, like Vodafone, really started to ramp up on the marketing to their sub base yet? And then, while clearly still early, anything you can help share on the international monetization of the subscriber base, and if you're seeing higher ARPU levels there relative to your linear subscriber base? Thank you very much.
Thanks, Robert. As I mentioned, we're really just getting started. We've built a robust platform, but in order to roll it out globally, it needs to be modified. It needs to be modified to be embedded with Vodafone, to be embedded with Telecom Italia, each of the different distributors. We're working on getting it embedded with a number of the cable players domestically and around the world. We have rebranded Dplay, Discovery Plus. As you know, our strategy outside the U.S., which we think is really unique, is local entertainment, local nonfiction, local sport in Europe, and local entertainment, local nonfiction around the world. And that library from the last 25 to 30 years of local content really differentiates us from Netflix and Disney and makes us, a great companion if you're putting together a bundle. So we are seeing some real growth in the few markets that we've launched in. We're using the Olympics as a forcing mechanism where we're looking to rebuild the platform so that coming out of we're ready with the Olympics all across Europe. And then coming out of that, we'll be able to roll out. But, for instance, Vodafone will not be for a little while. But, JB, why don't you give some more specifics?
Yeah. So, Robert, as David mentioned, we are obviously undergoing a significant amount of work.
That is one really cool deal that Discovery locked down, getting essentially the exclusive showing rights for the Olympics in Europe. That'll definitely be a huge boon to the combined company for sure.
The U.S. product to be our global product. We have some important kind of
Disney's basically locked down sports distribution in the United States, but it's cool to think that the Warner Bros. Discovery combination could be a very, very strong competitor in the European field.
Both of those things are our primary focus and taking up a fair amount of our engineering and product bandwidth over the course of the next 4 or 5 months pre-Olympics. So that's going to be the primary focus and getting that right in the first half of this year. As we come out of the Olympics and go into the second half of the year, that's when you're going to see the acceleration of the international rollouts. And so that's the time frame I think about. And using Vodafone specifically, since you mentioned it, really that will be a back half of 21 and even bleeding several markets into 22 as well as we launch with them. And then the third thing in terms of ARPU, the only thing I'd say there is, what we do know and what we've seen so far is these retail partnerships with the Vodafone and others, as well as our direct consumer, the premium and the multiples over our wholesale model internationally are still easily 3 to 4x the pricing that we see in our existing wholesale model. So we see a lot of pricing advantage in the Discovery Plus model and the partnerships we have versus our existing business.
Great. Thank you both.
Uh-oh.
Thank you. Our next question comes from Stephen
that line's not
from Wells
included,
Fargo.
huh?
Your line is open.
It should.
Yeah, thanks. Maybe first just wondering if you could update us on what sort of ARPU trends you're seeing on Discovery Plus, how those are performing versus your expectation, and maybe how those split between U.S. and international and subscription versus advertising. And then, David, I was wondering if you could give us an update on Magnolia in terms of timing. And you mentioned the Olympics and the golf season, but are there any other big content events that we should be mindful of during the year that might drive subscriber acquisition on Discovery Plus?
All right, looks like he fixed his own audio. I hate when some of the analysts call and they have like ridiculously high volume. I'm like trying to listen to it through my speaker while playing it through, but I don't want that to come through both ends. But okay, so here's their debt maturities. Got 14 years average maturity, 4% interest, almost $17 billion in book debt. We'll figure out what the market value of that debt is once we put the other numbers in. About 14 years is pretty good. That's a pretty good maturity schedule, especially considering they are going to be taking on extra debt to do this merger. So we'll have to see how that pans out once we do the pro forma valuation that includes all that.
Content coming from them, as well as all the content that we were putting on Magnolia. All of that will continue to be on Discovery Plus. we've come up with a really creative partnership, because Magnolia itself is a huge business for them, and a transactional business. And so we will be launching an app together where people can go and take all kinds of classes. They can do workshops. They can transact business with the Magnolia product. They can transact business with a number of things that Chip and Joe will be curating. But all the content that's developed will be on Discovery Plus. So effectively, when it launches, whatever number of subs that we have will be subs that'll have the Magnolia app available to it. So it's really a win-win. It becomes effectively part of us, and we become part of them. They become part of us, and it's 1 and 1 equals 2.
Okay. Stephen, let me take the question on ARPU. So a couple of points, what we're seeing so far, and remember it's early days, but starting with the U.S., I think the most important point that I've looked at is our ability to monetize the advertising side for the ad light subscribers, and I'm super pleased with what we're seeing there. We had this bogey of getting 3 times the CPM compared to linear. We're on a very good track here. We're already making more on a per sub basis altogether with these ad light subscribers compared to the linear ecosystem. So that's great. Obviously,
whoever followed me on Twitch, thank you.
Product. And I should say that
welcome.
The subscriber base is skewing a little more towards ad-free.
Subscriptions much appreciated.
Attractiveness of the price point here, I think. But so for the U.S. side, so far ahead of expectations. Internationally, as JB said, the most important point.
Yeah, maybe I do need to do these more in the afternoon than in the morning.
Delta between what we're achieving here on the direct-to-consumer side compared with linear. But I also want to say it's early days, and especially on the international side, driven by the deal cadence, et cetera, that number could move around a little. That's why you're not going to hear us talk a lot about ARPU specifically. I would like you guys to focus on the next generation revenue. That's why we gave the growth guidance there, and it's a very compelling story. I think we grew 18% in 2020. Fourth quarter was up 26% for next generation revenue. We're now looking at roughly 50% for the first quarter, and I expect that growth to further accelerate as we go through the year. So top to bottom, I think very, very encouraging for first results here.
The one other thing, Gunnar, that I might add just on for the international is that, based on the success we've seen in the last 45 days on the U.S. ad light product, that's really not a product that we've rolled out anywhere internationally. And we see an opportunity there to take that same model with the same higher ARPU and take it around the world. And so as part of the replatforming we talked about just a minute ago is going to enable us to offer an ad light and an ad-free product as we take Discovery Plus around the world. And I think in a number of markets, particularly in Europe with our big advertising footprint there, that we think there's going to be additional opportunity for higher ARPU growth with both products and both tiers in market at the same time.
Great, thank you.
Thank you. Our next question comes from Doug Mitchelson from Credit Suisse. Your line is open.
Oh, thanks so much, and congratulations to David and the team on the successful launch. A couple questions for Gunnar and a couple for David. Gunnar, one of the things that seemed pretty conservative at the Analyst Day was your target margin of 20% for streaming. Is it fair to say, you're pacing well beyond that, given some of the metrics you laid out? And if you threw all this into a blender, what kind of margins would you get on sort of a terminal basis for streaming? And a clarification, Gunnar, you said CPMs were up 40% over the upfront 1Q. You said up mid-teens year over year. Not to be sort of too in the weeds, but is that sort of booked to date, or is that your anticipation of how the quarter is tracking, including the March period last year where it fell off? And for David, when you think about the usage of the research you've done so far, I know it's early days. How do you feel about the idea? Is this super fans coming in and racing to try your streaming service? Is this just a mix of subscribers that you think is sustainable and normal and not overly driven by super fans? Or what's your anticipation there? And then lastly, David, if you wouldn't mind, on content and investment, it seems like at least our tracking, you'll tell me how far off we are. It seems like shows representing about 9% of your linear viewing has seen their originals debut on streaming. Is that sort of the right mix? Are you thinking of ramping that more aggressively, or is the originals that you have coming means that the linear is going to sort of stay with the content level that it has right now? Anyways, thanks for all that.
Sure. Thanks, Doug. Right now it seems quite broad. We're getting subscribers from our broad marketing. We're seeing subscribers coming in from our own marketing on our own platforms. We're seeing a lot of digital. The age is really across the board. A lot of that has to do, I think, with the great work that Disney has done in acclimating people. The encouraging thing is that we see good numbers about people once they know about the product, wanting to have the product. And we're one of the reasons that we're marketing is we think we got a great product and we need more people to understand what it is. For 60 days in with a product called Discovery Plus, we've had to do a lot of work. It's a great brand that people love, but we had to explain that it's home, food, Chip and Jo, crime, Oprah Winfrey. And there's all of this, all the stuff that people like. So that was number one. The roll to pay has been terrific. The amount of time people have been spending on is terrific. And so right now, it looks good.
All right, so we have an unlevered beta for their industry groupings of 0.9. Not too shabby, but definitely by shifting into a software-led distribution system, they were upping their overall industry risk.
So far, is it's very different than Disney or Netflix. We have this massive library, and when we say what's trending,
but that is tempered by the fact that 52% of the revenue still comes from advertising purely, so that's
10% of what people
nice.
are watching.
We'll see how the levering actually works for them, because as I said before, we do have a pretty significant debt pile for them, and they're going to be taking on more debt to do this combination. But the market beta that they're given right now is 1.38, so the fact that we're starting with 0.9 before the levering is pretty good, because I don't feel like they're going to reach 1.38. It might be like 1.1, 1.2 or something by the time we lever it up. But we'll see what that looks like once we get the other numbers in.
And other people
let's
are going
move
in
on
there and
to
watching the fact that we have the largest crime library, or paranormal, or food fans.
Their equity risk premium.
We're just experimenting. We're moving things around, but we still have a full commitment to the existing bundle. We are the bundle. I mean, it's basically news, sports, and us. And a lot of the other players are now they're in repeat mode. And for us, we have a real equitable argument. I was talking, with some of our operators over the weekend, about the amount of original content that we're still doing and the amount of viewership that we're getting on the platform. And so we think we could do both, and we're experimenting, moving things between the two.
All right, Doug, and on
they do have some RSUs, so we're actually going to include that as well.
Margin, look, I mean, I gave that, at least 20% number because I was very, very confident that we'd be able to hit it. If you look at what we've learned since then, every metric has come in better. So I think it's safe to say that that's even more conservative from today's perspective. At the same time, there may be some pulling, impact forward or so. So I'm not in a position to give a new estimate now. We're focused on, building this product out and optimizing this now. But I feel very, very good about the margin potential in the long run. And then on the CPM side, just to clarify, that the 40% are based on what we're seeing in our booking. I think that was your other question, right?
Yeah.
Just want to make sure we have a properly diluted share count.
Year-over-year, is that like pacing against the full 1Q of last year, or just bookings to date for the quarter?
That's based on what's on the books right now for the same.
Right. See if we can find their geographic distribution of revenues now.
As I said a couple of minutes ago, we do expect a modest headwind because we're using some of our inventory for our own promotion. Still have somewhat limited visibility, et cetera. Right? Keep that in mind as well, please.
Thank you both.
Thank you. Our next question comes from Kutgun Maral from RBC Capital Markets. Your line
I found
is
this
open.
number here where they distribute it from the US to international. I was hoping they'd give us more specific than that.
You're clearly more bullish on
We're not very far down yet, so
than you were maybe just a few months ago. You're ramping investments even more. Early subscriber KPIs sound very attractive, whether it's CPMs or churn. I guess I'll give it another shot and ask if you'd be willing to provide Any thoughts on what DTC subscriber levels you expect to achieve, whether it's
what the hell
US
this
or
is?
international or 2021, or even looking out further? Just any framework would be helpful. And then secondly, how do we think about the Go apps and what that business looks like going forward as you ramp and pivot even more into Discovery Plus? Thanks.
Well, let me talk about Go, which is really, our AVOD, where we're getting, terrific CPMs. It's been a great feeder, a really terrific feeder for us, which is really an efficient conversion. And, it's really, we have a holistic view here. We have our traditional business with great margins where we continue to, which we think outside the U.S. it's declining, but at a much slower rate than in the U.S. But in the U.S. we're seeing some stability. We expect that it'll decline, but we really like our position there. Then we have the Go AVOD, where we have a very young demo and a very good economics, and people continue to go there. And the more people we can get to go there, the more people can come over that want to get our SVOD service, which has a lot more stuff.
Here we go.
So we think it's really like a great 1, 2, 3 combo, and for advertisers, it's terrific. So we're going to continue to look at the market, and as JB said, we're evolving. We have a very low-priced product. Given the marketplace, it's an unbelievable value. If you look at the value of us at $4.99 an ad light versus everyone else, with the library we have and the originals, it's terrific. Outside the U.S., we can go a lot cheaper than that and still have a multiple of the ARPU that we get. But as JB said, we're learning. We've been at this for 5 years. That's how I think we took so much time to launch, to figure out how do we get everything.
So they still didn't really give us anything super specific for the revenues, but they at least gave us something a little bit more specific for the assets, which is kind of nice. Weird, it's normally the other way around.
With low commercials.
Whatever.
But we'll also in some markets.
Whatever. We'll just use the global equity risk premium for the non-US.
And we've been doing that in a couple of markets already and finding that that's a real feeder. And the fact that we have advertisers in Go, that's one of the reasons we have 100 advertisers in Discovery Plus right now. So who knows where
Poland in the UK.
Right
it's very interesting that that's their
ARPU on our existing business.
Oddly specific locations for production.
And we like the metrics, and we'll just follow the consumer need. I don't know, JD, just maybe a little on AVOD from your perspective.
Yeah, I think the interesting thing, back to David's experimentation point, is that we have done some things even in the course of the last 60 days where we initially took down some content that was originally on Go and then put it back up. And I guess the point would be generally, to David's point of, these are just incredibly additive customer segments. I think we look at each of these as being very additive customer segments. And the Go performance so far, even in the course of Discovery Plus, has continued to see the same high level of engagement as we had pre-Discovery Plus launch as we have post-Discovery Plus launch. And so from an engagement perspective, all indications are, which was again a little bit of our thesis back in December, which we obviously didn't know 100%, but that this could be not an either or, but an and that so far it is looking a lot more like an and even than we might have expected back in December. And on Go, we're still very pleased with the engagement and the level of usage that platform is getting. And we have some new product innovations that we're going to be rolling out over the course of the next couple months that we think will continue to make that product ever more compelling. And so we feel comfortable with that business continuing to be a good growth, a healthy growth driver for us going forward.
And then maybe just to close out that last question, we're still not in the position to give a long-term or short-term subscriber guidance here. We're super happy with what we're seeing. Again, top to bottom ahead of expectations. We have a lot of distribution still coming down the pike. We're really just getting started internationally. So that's on the positive side.
So it's about 66% of the revenues comes from the U.S., 34% from non-U.S.
Scenarios here.
Understood. Thank you all.
Thank you. Our next question comes from Ben Swinburne from Morgan Stanley. Your line is open.
Good morning. David, I wanted to ask you about your sort of content plans as you look at linear versus streaming in the U.S.? I mean, I think of Discovery, you've been probably the most deliberate, I think, in balancing what you deliver to your MVPD
53% of their long-term property equipment is in the U.S., with a pretty good balance of some other property in Poland, UK, as well as a decent amount in other non-U.S. countries.
Are you feeling more kind of optimistic or comfortable, putting your best IP on D2C versus linear in terms of exclusives or other things? Just give us a sense of your mindset sitting here today. And then, Gunnar, you gave some advertising commentary for Q1. I'm just wondering if you could talk about the shape of the year. Obviously, the comps get pretty easy in Q2, Q3. And then would you be willing to give us what the next-gen revenues were in dollars last year? Thank you, everybody.
Thanks, Ben. One of the great things is we get to see what people watch and how they watch it and what they like. And I wouldn't say best, I would say different. We're continuing to invest in our traditional channels around the world, and that's building our global IP library. And so we'll continue to do that. It's still a great model, and we think it's going to go on for quite some time. It's also a terrific feeder. So the people that are watching our cable channels are buying the product. People that are going to go and seeing some of the product that they've downloaded and they like, they're buying the product. So we think it's really advantageous to us to keep that nourished, and it's good for us with our existing distributors because they appreciate that and that we're key to the bundle and we're supporting it.
Okay, so an equity risk premium for the revenues of 5.08 and an equity risk premium for their property of 4.04.
Put it on ID, but some of those things are.
Which, if we weight it 50% for each, then it comes to 4.56, which is a little bit lower.
I think it would have done well. It did unbelievably well.
In the U.S., wait a minute, there must be something wrong here. Oh yeah, okay, that's what it was. Didn't add this part in. That didn't make any sense. Yeah, okay, so the weighted. So 5.14 versus 5.08, so it comes to 5.11 as a weighted country risk premium of revenues and production, which if we use the updated equity risk premium, which actually, hold on just a second.
Sort of in two ways. One is
it's Monday, so I should probably be updating my equity risk premium, assuming there's new numbers out, which there is. So.
Where if you love Fixer Upper and you love the Property Brothers and you love Guy Fieri, you can just put that into the app, and that's what'll run all day long. And so on the one hand, you may really want to watch the Attenborough or this great crime documentary, or Ina Garten is doing a great show with Melissa McCarthy. But you also may want to just put it on so you have something
so
really
the earnings
fun
are going to rise up like 30 cents for the year. The S&P 500.
And a lot of the SVOD products are there for intention.
Also up about 30 cents for next year as well.
Intent to view, which we have.
Analysts have gotten a little bit more bullish on the S&P's earnings for the next 2 years.
Ability to be a companion.
And it's roughly in line. I try to leave it a little bit below the current index level. Leave it in line, so really we didn't shift it around too much, but either way, I'd like to update that every Monday.
Fantastic differentiated content that people love, and also.
So the equity risk premium we're going to use for Discovery is 5.14, with the Treasury being 1.63 today, or at the close of Friday, perhaps still.
Cable networks in America, with our three
okay,
women,
so that's all of the little.
And there's a reason for that behaviorally. People sometimes want to have that on, during
early stage pieces that we have to handle. Now we can move on to the actual financial statements.
And then Ben, in terms of advertising, I mean, visibility is still limited. I'm not in a position to come up with a full year outlook here, but obviously you're right that the comps should start looking a little better from Q2 on. We've seen this sequential improvement, and as I said earlier, some of the international markets have actually already been
Oh, wait a minute.
In Q4, and we see strong momentum into Q1. It is early. I mean, I told you about pricing. We do have a great upfront deal in place. Option cancellations are looking good right now, but again, we don't have a ton of visibility. So we'll see, but hopefully, the balance is going to skew positively starting Q2 here. In terms of the next gen revenue,
just want to, we were able to make two meaningful hires that have really been helping us. One is we hired the head of sales for Hulu.
Jim Keller, yeah.
Jim Keller, who's really terrific. We have a great team,
Jim
but how do
Keller.
we take ourselves to the next level? And then we just hired last week the head of
the CMO.
Yeah, the CMO from Hulu to come over.
Sales to capital
And
ratio
so
for
we brought
advertising
over a lot of
is
expertise
pretty
here that we think
pretty high,
selling
5.17.
our product, selling the digital product, getting someone that has years and years.
Much
of
lower for cable
experience doing
TV.
that, together with the very
Much lower
strong
for
team
entertainment
that
production,
we have. Steinloff's
but
doing
still
a
pretty
fantastic
decent,
job.
because really
And
anything
then
over
take the
1
great
is
marketing team that we have
pretty decent.
with all the strength, and you've seen the campaign, and bring someone who's been doing just subscriber acquisition for the last 8 years, is going to help this company really grow.
So we come up with an industry expected sales to capital ratio for the types of industries they're in of 3.11. That would be $3.11 of new revenue for every $1 of capital invested in the company. Would be what we would expect to see out of them.
50% and then accelerating from there, and to be quantified. But it's a great story, I think.
Thank you.
Thank you. Our next question comes from John Hodulik from UBS. Your line is open.
Okay, great. Thanks, guys. Maybe for Gunnar, just some clarifications on some of the cost items. You talked about spending some more on the content spend. I think you guys have spent about $3 billion a year the last couple of years. So can you give us a sense of the magnitude of the increase there? And then on the guide, any chance you could sort of bucket some of the areas that you might spend leaning into D2C with that incremental up to $200 million in EBITDA? That'd be great. Thanks.
Yeah. So starting with content spend, two things to keep in mind for this year. One is the Olympics is going to flow through with a very significant license fee, of course, in the third quarter. Other than that, the content spend on a consolidated basis for the entire company is growing significantly. That's part of that guide that we have given, obviously with a focus on direct-to-consumer first product. But keep in mind, as David said, we're experimenting with those windows for our content. And I think one of our great advantages has always been our ability to use that content across territories, across platforms, and thereby further drive.
And their adjusted net margins, we would expect for their industry groupings to see about 12.07%.
In terms of what we see additional spend right now, first and foremost, it's marketing. And again, I said it earlier, but given how our engagement churn metrics and the monetization metrics are trending, our customer lifetime value looks much better than what we thought it was going to be in December. And at the same time, subscriber acquisition has been incredibly efficient, a little better than what we planned for. So that gap.
All right, so now we can move on to their
customer lifetime value and SAC
yearly
is
financials.
very compelling, and that's the largest driver for us to really lean in and spend more on the marketing side, all the way through the funnel. Initially, a lot of top of the funnel marketing, but we'll definitely keep firing on that performance marketing side as we go through the year here. And then in addition to that, on the technology side as well, there's a lot of fast follow features that are in the pipeline. The team is working hard. JB already spoke about replatforming. There's some work to do internationally as well. But again, all of that is going to help us accelerate the rollout here. It's going to help us accelerate the advertising growth. David already mentioned, binge ads and pause ads and interactive ads, et cetera, that are coming down the pike as early as March, April, May, et cetera. So it's very exciting. And again, from the CFO perspective, what gives me a lot of comfort is this is success-based spend. We're going to toggle it up and down with what we see in terms of the performance of the product. And again, I could not be more excited about this being the best use of our free cash flow right now.
Thank you.
Thank you. And our next question comes from Rich Greenfield from Lightshed Partners. Your line is open.
Hi, thanks for taking the question. This is sort of a follow-up to a couple of questions that have been asked. When you think about the Discovery Plus product to date, when we look at it, 12 of the top 13 shows have been sort of shows on TV or on linear TV, led by Travel Channel's Ghost Adventures. The only one that's been exclusive to Discovery Plus has been actually
Okay, yeah, it is right.
from Chip and
I don't know why, but that revenue number felt like I had put a lower number in for the when I was doing the segment, so I was like, wait a minute, what? But yeah, I guess so.
Programming than other streaming services because people like watching your catalog content.
And this analyst is fairly audible.
Fixer upper sort of points you in the direction of maybe Chip and Joanna shouldn't be launching a cable network and it should just stay exclusive. Their content should stay exclusive to Discovery Plus. And then just the last piece of that, you mentioned pausing the share buyback to invest in Discovery Plus. I guess just given investor excitement over your stock and the huge move you've seen in your stock year to date, why not take advantage of it, actually sell stock, strengthen the balance sheet, and actually invest even more in programming? Again, maybe you don't need to spend that much on programming given what I mentioned before. So I just love your views on that whole subject.
Sure. Let me start with the content. We've never made our entire library available before. So one is there's a lot of excitement about being able to sit down and watch all Mythbusters, look at all the seasons of Deadliest Catch, Ice Road Truckers, go back and watch a bunch of Lifetime movies all in one sitting. So we're making available this whole bucket of content, all the food. Go back, Guy Fieri, spend an afternoon watching Diners and Dives. So there's a lot of appeal in our full library. Two, there's a huge amount of original content that is on there that's doing really well. The metrics are really not the same for us. If you take those top 12 shows, that's less than 10% of what's viewed on the platform. So, I'm not on the inside of these other SVOD platforms, but when they launch a big movie or they launch a big series, if they name 3, it might be 30% of the viewing or 40% of the viewing. For us, it's less than 10%. So our product is a lot of long tail. And a lot of the original content is very helpful, I think, because it makes it is clear that it's differentiated. One of the reasons why a lot of people that have Go are moving over and paying for this product is there's more there and there's a ton of original content. So we think we're onto something with the mix. We're not being guided that much by seeing that they're watching this show or that show, because when we actually look at the full numbers, the answer is that we've represented 50% of what people watch on TV. And that's not available anywhere else. You go to the others for scripted series and scripted movies, and the big takeaway for us is people are willing to pay for that other 50% so far. And that could be a yellow brick road for us.
And Rich, on the share buyback side, remember we have so much free cash flow coming in, right? So that generates a lot of firepower to fund our organic acquisitions. On the leverage side, as I said before, I'm feeling very good. And not only I'm feeling very good, agencies are supportive as well. And the reality is we have less than $4 billion coming due over the next 5 years after our prepayment here and that's going on in March right now. So I think we're in a very good position. We are prioritizing the reinvestment into our own company right now, but not in the form of buybacks, but in the form of future growth.
I think.
And what about Chip and Joanna?
As I said, we've done a very innovative alignment together, and you're going to continue to see content on Discovery Plus exclusively. There may be a window. Maybe we think linear is still valuable. They've produced a lot of good content, but you'll be seeing a tremendous amount of content coming from them and coming from their creative factory that'll be on Discovery Plus exclusively, or exclusively for a period of time before it shows up somewhere else.
I think the only other thing I'd add, Rich, to your comment about the franchises is that, I think one of the successes we've found, you mentioned the top shows and how many, there's a lot of the top shows on Discovery Plus right now that are existing talent or known franchise base. So you take a Magnolia's Table or a Bobby and Giada in Italy, or even some of the offshoots of the 90 Day franchise. And I think that's one of the things we see as a great success is ultimately being able to super serve and give people even more. But that stuff is exclusive to Discovery Plus. And so while it could fit naturally in a second window or down the line back on a network, because it's very complementary to the existing franchises, they are exclusive to Discovery Plus. So we do think, in order to continue to expand the base also, that will be important to have a right balance of certainly some of the library and the depth of the library is incredibly important, but also some of the exclusive content, even if it is based on some IP and franchises that come from the television networks.
And outside the U.S., we're finding that with our local language, local sports strategy, that having a particularly compelling piece of local IP that's available exclusively is driving. I mean, speak to that a little bit, JB. We're seeing real growth in Poland when we take, a particular piece of compelling local IP and put it just on our Discovery Plus product.
Yeah, I mean, consistent with what we did think in our hypothesis, what we outlined is what we thought was sort of part of our secret sauce back in December, of this combination of great local IP with the strength of the global library. We are seeing that bear fruit, which is, a lot of the local IP that is, whether it be in Poland, the Nordics, the UK, Italy, is what's driving a significant amount of volume to the service and in terms of the acquisitions. And then coming into the service, finding and discovering all this new and great content that people had never seen. And I think the other thing, this is true about international, it's also true about the US, is the reality is the 55,000 hours is such a large volume of content in the genres and passion areas that people love, that without a digital algorithmic recommendation engine to surface that stuff to people, it's just never something that could have been perfectly exploited on linear television when you have a 24/7 channel and you are limited by capacity. And so, and by the way, that replatforming that we're doing internationally is partly to take advantage of the more sophisticated recommendation engine that we have on Discovery Plus that currently doesn't exist in Discovery Plus outside the US, but will once we finish the replatform. So that surfacing of new content, even if it's out of the library, that feels new to so many viewers, I think it's also a big opportunity to satisfy the consumers.
Very helpful. Thanks for the details.
Thank you. And our next question comes from Alexia Quadrani from JP Morgan.
There we go.
Your line is open.
Thank you. Just two quick questions, if I may. The first one is, can we expect you guys can even get a higher proportion of advertising budgets given the incremental reach of Disney Plus? It just sounds like it's a very attractive overall, offering you can provide as Discovery as a company to advertise. I'm curious if the incremental cost is there. And then the second question is just really on local international production. Are you seeing that getting a bit harder or get a bit more expensive now that, Discovery Plus and a lot of other streaming services are trying to build up on local content?
Thanks, Alexia. On the ad budgets, getting back to it, even before we get to Discovery Plus, with our traditional business, what Steinloff has been and his team have very effectively done, and he and I have been on the road with with all the big agencies at least 3 times since the Scripps deal, is dealing with the fact that the broadcasters are getting over $60 in CPM, and we were getting a third of that. But we're the number 1 player for women or the number 2 player for women. And we have the number 1 network with TLC. We have the number 1 show with 90 Day Fiance. And so we've been pushing that rock uphill. And you see in our numbers how we've been driving that CPM. But now we have a whole basket where we have this win-win of come in with us for $40 plus CPM. Why are you going to get a repeat on a broadcast network when you could buy original content on us? And we get a huge premium on our CPM. We believe that this should ultimately flip. That aside from sports, we should be getting a premium versus the broadcasters, because we're producing. We have length of view. We have an audience that's engaged. We have endemics with food and home where advertisers want to be, and so we think we have some real momentum there, and we're going to push on it because we think from an equitable perspective and from a performance perspective, we should see much more of that money with much more CPM, with better returns. And we think advertisers are starting to agree with us, and you should see that flowing through over a period of time. And with Go and Discovery Plus, we do have a lot more opportunity, because with Discovery Plus bigger than we thought, with Go continuing to perform, we have more capacity. And we're seeing that the attractiveness of that capacity in terms of the kind of premiums that we're getting in CPM on Discovery Plus, where there's only a few ads, is really terrific. So it's incremental reach, real incremental reach for us, non-cable, and so which is quite helpful. And on the local, leaning in, we do need original content. We have been doing it. JB's been producing a lot of it in every language. We have the factory that converts all of our content into every language, but we are doing more original because it's helping us both on linear and direct to consumer. But JB, talk about how we've kind of pivoted this year to lean in even harder.
Yeah, I think certainly in the core markets with the biggest scale, we'll continue to sort of pivot on and focus on the right level of local content to drive the acquisitions. I think the other thing that's exciting for us that we've never been able to take advantage of in a material way is we have now, even in the last 90 days, examples of shows that originate out of one market that are top 10 or top 5 in some cases drivers in other international markets. And so when we talk about local content used to only mean monetization in one market. The reality is now we're starting to see more value and benefit being driven out of local content multi-market. So we did an Estonia documentary on the terrible and tragic capsizing, the largest ferry disaster in the Nordics that was originated out of our Nordics business. It's now a top performer in the UK, a top performer in Italy. And so local content investment doesn't just mean local. It means local with value now to travel, which is something that we never had. So we're excited about that opportunity as well.
Thank you.
Thank you. And we'll take our last question from Michael Morris from Guggenheim. Your line is open.
Hey, thanks, guys. Good morning. I'll try to sneak a couple in here if I could. First, can we talk a little bit about the affiliate pace domestically, and especially the strength you're talking about in the first quarter? The 5% that you saw in the fourth quarter, that seems to all be coming from the linear business. And I'd appreciate if you could talk about what drove that acceleration. I know we talked about a little bit of the improvement in subscribers, but really it seems like you would have had to have some kind of pricing, discrete pricing improvement there. So can you just help with that and how much that impacts that underlying pace, as we go into the new year and that growth you're expecting? And then just a couple on international digital, if I could. Of the 5 million subscribers, next-gen subscribers you discussed in the fourth quarter, how many of those were Dplay subs that sort of became Discovery Plus subs on the conversion? And then the last thing, can you talk about India and your product in that market at all, where you are on that, and if that contributed to your reported numbers this quarter? Thanks for taking the questions.
Okay, Michael, let me start with the distribution guidance, and you may have noted that I deliberately said distribution rather than affiliate because I do not want to create the perception that our traditional affiliate number is accelerating by 100% here. So you're 100% right. We were up 5% in the fourth quarter, and that was almost completely traditional business driven. It's a combination of pricing, slightly better subscriber trends. We've lost less than in prior quarters, and also we've done very well on the side of the virtual MVPDs. So that's the Q4 number, mostly linear. For Q1, we're talking about high single digit, potentially double digit. Then a lot of that acceleration is obviously coming from the D2C trends, given the subscriber success that we've seen so far. That is going to start very materially contributing to that number. That's why I started talking about distribution the way we lay it out in our financial statements as well, rather than just affiliate. On India,
well,
you can say, what was JB? Yeah.
I mean, on the international, Michael, to your question on international, the vast majority of those subscribers are Discovery Plus. So it's and if you add in the Eurosport player, which will convert, it's really vast majority of subscribers. So that's number one. Number two, on India, Look, it's been a nice business. It's grown for us nicely, but it remains, in terms of obviously the logical questions of that being a lower ARPU market. It remains a small piece of the overall, kind of single-digit level percentage of our international portfolio today. So it's grown nicely, but it remains a smaller part of the overall international subscriber story.
And JB, just to be clear, that I'm trying to reconcile the 5 million subs and the part that you said the vast majority were Discovery Plus. I guess, are you saying the majority of the 5 million that you guys discussed in December converted to become Discovery Plus? So more than half of those 5 million?
Correct.
Okay, that's great. Thank you very much for that.
Thank you. Ladies and gentlemen, that does conclude the question and answer session for today's conference. Ladies and gentlemen, this now concludes today's conference call. Thank you for your participation, and you may now disconnect. Everyone, have a wonderful day.
Ladies and gentlemen, thank you for standing by, and welcome to the Discovery, Inc. First Quarter 2021 Earnings Conference Call. At this time, all participant lines are in a listen-only mode. At the conclusion of the speaker's presentation, there will be a question and answer session. Also, please be advised that today's conference is being recorded. I would now like to hand the conference over to Mr. Andrew Slabin, Executive Vice President, Global Investor Strategy. Sir, you may begin.
Everyone, thank you for joining us for Discovery's Q1 earnings call. Joining me today are David Zaslav, President and Chief Executive Officer, Gunnar Wiedenfels, Chief Financial Officer, and JB Perrette, President and CEO, Discovery Networks International. You should have received a copy of our earnings release, but if not, feel free to access it on our website at www.corporate.discovery.com. On today's call, we will begin with some opening comments from David and Gunnar, and then we'll open the call to take questions. Before we start, I'd like to remind you that comments today regarding the company's future business plans, prospects, and financial performance are forward-looking statements that we make pursuant to the safe harbor provisions of the Private Securities Litigation Reform Act of 1995. These statements are made based on management's current knowledge and assumptions about future events, and they involve risks and uncertainties that could cause actual results to differ materially from our expectations. In providing projections and other forward-looking statements, the company disclaims any intent or obligation to update them. For additional information on important factors that could affect these expectations, please see our Form 10-K for the year ended December 31st, 2020, and our subsequent filings made with the U.S. Securities and Exchange Commission. And with that, I'd like to turn the call over to David.
Good morning, everyone, and thank you for joining us today to review both our Q1 performance and the meaningful progress we are making since our launch of Discovery Plus. Across our operating segments, brands, and global markets, I couldn't be prouder of how our company has executed, near flawlessly, responding with creativity, precision, and focus across the board, while at the same time accelerating the pace of innovation throughout our organization as we embrace substantial growth opportunities around the globe. We continue to reposition the company and put it on a path of sustainable growth for the long term. Our ability to generate free cash flow is crucial, allowing us to fully fund our pivot and underscoring the efficiency of our model. Indeed, even during this moment of increased investment, as clearly evidenced in our financials this quarter, our free cash flow machine is working harder than ever, and it is reinforcing an evolving narrative about Discovery's differentiated hand. With the strong global launch of Discovery Plus, we are now scaling a very well-received global direct-to-consumer offering.
All right, now that we've got all the
linear channel presence
share counts away for the 7 years we're going to look at.
In Q1,
I'm not really going to go back further than that because no R&D costs, so I don't really feel the need to get the amortization effect further back than that.
Of linear share growth, anchored by our 27th straight month of growth in our female genres and best ever quarterly performances in several markets, including the UK, France, and Germany. This growth was supported by the continued global expansion of our Scripps lifestyle brands and content. We achieved this while simultaneously launching and building Discovery Plus. Our continued strategic focus leverages Discovery's powerful competitive advantages, well-established consumer connections in every market in the world, vast local language IP ownership, deep and expanding distribution relationships, and a super efficient content production model to power both our global direct-to-consumer expansion and our core linear business. To achieve this, we are investing more than ever before in our content across the board to support these platforms. So far in 2021, it is all coalescing and exceeding all of our early benchmarks across almost every KPI. We are pleased to report that just 4 months into our U.S. launch of Discovery Plus, and with the vast majority of our international expansion still ahead of us, we have 15 million total paying subs across our global direct-to-consumer base. And we continue to move forward with strong momentum. When I think about our 15 million direct-to-consumer paying subscribers that we have today, and the fact that we were able to add 10 million paying subscribers since the end of last year, I'm just really impressed with our traction. At the end of Q1, we crossed 13 million paying global next subscribers, representing sub growth that compares quite favorably to our peers over the same period, underscoring the value, appeal, and stickiness of our content, all of which supported our conviction about our opportunity ahead. But our sub count tells only part of the story. We are equally encouraged by early metrics and KPIs across engagement, churn, and monetization, and Arpu, particularly in the U.S., which likely place us at the very top of an impressive list of peer offerings, many of whom have had a far longer runway thus far than we have. Roll to pay has been between 80 and 85% of free trial subs. Engagement is approximately 3 hours per day per viewing subscriber, and well ahead of linear. Retention is strong, giving us confidence.
Just a second, I'm gonna go back and look at the 2020 cash flow statement one more time. Make sure I didn't screw something up.
Consumers clearly love the Discovery Plus product. We see that on social, in the App Store product ratings, and the feedback from partners, clients, and talent in the marketplace. Our App Store ratings rank as among the top. Our Apple App Store rating.
I thought it was odd that our cash flow came out so low.
And based on a very large number of reviews. Our strong early KPIs are driving exceptional monetization. Our $4.99 ad light product, with only 4 minutes of commercial time, generated over $10 of ARPU in the quarter, already well ahead of our
yeah, see, that makes much more sense.
And it's still trending up.
Forgot the content amortization.
Our overall blended
I just read the depreciation amortization line, but got to include the content right amortization as well.
And we see healthy momentum for that figure to grow during the course of this year. And on a global
that definitely makes much more sense. I thought it was a little odd. I was like, wow, maybe they really just did have a bad cash flow year last year, but it still didn't quite make sense in my mind. But yeah, okay, so I did make that mistake.
Customer lifetime.
No problem, we caught it.
Particularly as contrasted against the cost to gain a subscriber, encouraging us to lean in from an investment standpoint when it comes to marketing, content, and technological capability in order to maximize this meaningful growth opportunity. We have an extremely focused approach on all the ways we can be available to the broadest swath of users while driving a rich and dynamic user experience. A cornerstone of this will be expanding our partnerships with many of the world's leading distributors and platforms. We recently launched on Comcast Xfinity Flex, and soon on X1, and are deepening our relationship with Amazon around the globe, with availability on Prime Video channels in the United States and a global rollout plan for other PVC markets. Now let's look at
it especially didn't make sense, especially since they had such a negative working capital cash flow year last year. I was like, well, maybe that's just an outstanding year, but now I can see right this is pretty consistent, which is why you definitely need to make sure it balances out with the content right amortization. It's like you add back content right amortization, but then you make sure you're taking out the content right essentially capital expenses that they are using as part of the operating cash flow, but it is part of the capital regardless. It's working capital.
Like a number of other markets in Europe,
CapEx
is relatively underpenetrated with respect to pay TV, roughly 20% with really one main distributor. It has significant mobile penetration and usage, and where Discovery enjoys a healthy pay and free-to-air presence with depth in local in-language content. And though we have grown our audience share, the existing pay TV market structure limits the upside from this segment of the ecosystem. The launch of Discovery Plus has catalyzed a new growth trajectory. Our addressable market has grown more than 10 times, from pay TV to now include mobile and broadband. Discovery Plus enables an entry cost for premium video that's 75% plus more affordable than traditional bundles. And Discovery Plus Arpu are already more than 3 times greater than our wholesale portfolio. This is a powerful combination of potential universe and price growth. What we are seeing in Italy guides our thinking on the prospects of what our other international markets could look like. There are significant markets such as Brazil, Germany, and Australia with similar characteristics, and where our ability to offer a direct-to-consumer offering, packaged with mobile or multi-platform operators, should ultimately result.
Good to see that at least so far they're not overpaying their shareholders.
And a deeper direct connection with our. Of equal importance is the balance we have been able to strike across our linear and direct-to-consumer businesses. Reflecting on our Q1 performance, which by many measures is still facing COVID-related headwinds, I'm proud of our team's ability to manage through difficult operating circumstances, and you will see that in our Q2 outlook. Gunnar will take you through the details, but I'm pleased to note that in every international region is seeing positive advertising growth versus 2020, with record shares in Q1 from major markets like UK, France, and Germany. We are seeing the great resilience in our advertising, not just internationally, but also domestically. This, taken together with very strong scatter pricing in the U.S. and public spending across the globe, give us confidence in our advertising outlook for the balance of the year, especially with the growing Discovery Plus opportunity. We couldn't be more excited to present to our advertisers at this year's upfront on May 18th, at a time when our brands and programming have never been stronger or more relevant. At the same time, growth in both domestic and international distribution revenues will be boosted by Discovery Plus. Net-net, we see a healthy inflection in our revenue trajectory behind a global backdrop of improving underlying advertiser demand and continued share gains, particularly in our international markets. Taking a step back and assessing where we are as a company, I'm extraordinarily optimistic. We've gotten off to a great start with Discovery Plus, exceeding our expectations.
And so far the retained earnings is also going up. That's also good.
An exciting a time as I have ever
Doesn't necessarily matter, but it's a good sign.
In the media business. We are encouraged by the engagement and reception to Discovery Plus from our consumers, advertisers, and distribution partners around the globe, underscoring the strength of our differentiated hand.
Uh-oh.
This is an
What a screw up.
tailwind that gives us
Screwed
great
up something.
confidence as we lean even harder into our...
What's in the liabilities I screwed up? What did I screw up?
Yet, as important as Discovery Plus's success is to the future prospects of the company, of equivalent importance is our core linear business.
Oh, okay.
The foundation of the company and backbone of our strong free cash flow. As we drive and generate long-term sustainable growth, it is imperative that we nurture both sides
There we go.
of the company as interconnected and supportive to one another. Thank you, and I'd like to turn the call over to
That's
Gunnar.
correct, but I still screwed up something else.
JB, Gunnar, and I will take your questions. Thanks so much.
Thank you, David, and good morning, everyone. My aim this morning is to provide a slightly more detailed peek into the operating model as well as our near-term outlook than we would normally do, in large part
There we
due to
go.
recent volatility. To the extent that this has created additional questions and or concerns, my goal will be to help alleviate as much of that as possible this morning. 2021 is off to a great start, as David just mentioned, in which I'll provide a little more context on. KPIs, particularly in the U.S., where we launched at the beginning of this year, across engagement, monetization, and churn, and implied customer lifetime value, continue to reinforce our belief that prioritizing investment in Discovery Plus will generate superior returns. As noted, engagement is truly stellar, with viewing subs watching roughly 3 hours of content per day, well ahead of linear, and naturally an underlying contributor to both retention and monetization. And retention is indeed looking very encouraging, with churn coming in quite a bit lower than we had initially anticipated. While it is still too early to evaluate a stable monthly churn rate, the retention curves of our first subscriber cohorts are looking very encouraging. Based on these early observations, we expect churn to trend towards low single digits over the course of the next 12 months. Turning to monetization, which is also well ahead of plan. Blended Arpu for Discovery Plus in the US is already in line with our $7 linear take, buoyed by the strong monetization of the ad-light product, where Arpu has already exceeded $10 in the first quarter. Clearly, strong engagement and watch times, despite offering only a 4-minute ad load, are lending themselves to healthy advertiser demand and, in turn, exceptional CPMs. Still early days, so we see a notable path for further monetization as we continue to scale and drive additional engagement, attract additional advertisers and brands, and roll out new advertising products. Global ARPU is over $5 per month, with international ARPU is expected below that of the US. This is in part due to the market price points, and in part because we are launching the greater share of our subscribers coming through promotional partnerships, which drive faster adoption and marketing efficiency, but also come at an initially lower ARPU. That being said, we are in virtually all cases seeing ARPUs that are multiples above the existing wholesale linear pay TV fee at which we currently monetize our product. This, of course, is a core tenet of our international Discovery Plus strategy and a great objective testament to the quality and value of our content in a marketplace not limited by the boundaries of traditional pay TV ecosystem. Taking these metrics together, we are modeling a much more substantive estimate of customer lifetime value, while subscriber acquisition cost is currently running at a very healthy cushion to that lifetime value. Based on these trends, we're increasingly more confident with our outer year projections and our target margin profile of 20% at scale. While it's still too early to formally update this number, we believe there is meaningful upside to the target based on all these initial indicators trending above our business case assumptions. During the first quarter, next generation revenue increased 52% year-over-year.
Made a big acquisition in 2018.
With next generation revenue set to more than double year.
$8.5 billion.
We did invest heavily in marketing spend in the first quarter to support the U.S. launch of Discovery Plus and rebranding of Dplay in key international markets. A sizable portion of which was dedicated to upper funnel brand marketing to build awareness, as well as bottom of the funnel performance marketing. This accounted for the vast majority of the year-over-year increase in OpEx, alongside content and tech spend. In the aggregate, next-gen AOIBDA losses were roughly $400 million in the first quarter.
We expect a modest sequential improvement in next-gen losses in Q2 as continued substantial marketing efforts to roll out additional territories and requisite content and tech spend will begin to be offset by more material revenue contributions. Also, we expect to better optimize and
They paid for it with shares, which explains the share count jump after this into 2019.
ultimately falls into 2021.
Doesn't show up here in the debt financing. The fact that the free cash flow to equity is negative 6.6 billion. Whenever free cash flow to equity is negative, it basically means either cash is leaving the company or shares are issued, one way or the other. One of those two things. Because free cash flow to equity is after the debt issuance, which is the difference between normal free cash flow and free cash flow to equity. Go down.
About the magnitude of these expenses and their impact on our financials.
Where do I have it?
Yet we are reassured by the compelling return metrics against this spend.
Here.
Now turning to the segments. In the U.S., advertising finished down 4%.
Yeah, free cash flow is super negative.
In large part due to universe estimates and PUT level declines, which ultimately translated into lower impressions across the industry and our networks. That said, we continued to outperform our pay TV network peers on share during the quarter. Moreover, pricing remained robust, scatter CPMs developing strongly during Q1, expected to be up around 30% year over year, with roughly 50% premium versus upfront in Q2. In fact, total dollar volume for Q2 scatter will be up considerably versus last year, as we see categories such as auto and travel coming back, as well as from the influx of D2C companies, including many new to TV ads. Discovery Plus had started to advertising revenue in Q1, and subscribers grew throughout the quarter, and we expect an increasing tailwind from this component through Q2. As such, we expect U.S. advertising revenue to grow in the low double-digit range in Q2, helped in part by COVID comps, strong pricing, and advertiser demand across the pay TV ecosystem. U.S. distribution revenues were up 12% during the quarter, at the higher end of our expectations. Mid-single-digit linear distribution revenue growth continued to be supported by contractual affiliate fee increases, partially offset by pay TV subscriber decline. Subscribers to our fully distributed linear networks declined by 2%, while our total pay TV subscribers declined by 4%, likely top-of-peer performance, helped by additional network carriage from recent affiliate renewals and continuing share gains at virtual MVPDs, where we remain very well funded across all key platforms. In addition to our healthy traditional affiliates, the launch of Discovery Plus and the subsequent ramp-up of subscribers accounted for much of the sequential acceleration of distribution revenue. During Q2, we expect reported distribution revenue growth will accelerate further, even against a much tougher comparison given the significant one-time benefit recognized last year, implying a significant acceleration on an underlying basis, supported by similar drivers as in Q1. Turning to international networks, which I will discuss as always on a constant currency basis. Advertising grew 8% during the first quarter as all international regions, EMEA, LATAM, and APAC, returned to growth, the first since the start of the COVID pandemic. Latin America developed positively, driven by Brazil and Mexico, and despite intermittent lockdowns in certain EMEA markets, we saw mid-single-digit growth across the region due to continuing share gains in key markets like the UK, Spain, and France. Finally, APAC was also up significantly. Q2, as we count the substantial declines faced by the advertising industry last year during the initial stages of the COVID pandemic, we expect international advertising revenue growth to exceed 50%. International distribution revenue was down 2% in Q1 due to lower linear pricing in certain European markets, partially offset by our growing Discovery Plus subscriber base. We expect international distribution revenue to accelerate to mid-single-digit growth during the second quarter, driven by the same factors. As we've called out in prior quarters, as we reposition a number of key international distribution partnerships towards a hybrid-type structure, we've opted to trade nearer-term upside on the linear portfolio for greater term support for our DCF efforts. Segment performance has already reflected some of the impact of this over the last
actually, hold on. Pay no attention to that. We're nowhere near done.
Total operating expenses for the consolidated company were up 21% during the quarter.
but I do want to come down here and take a look at this. So, okay, so our levered beta actually comes up to 1.63 because debt to equity is actually higher than I thought it was. So that actually gives them a cost of equity of 10%, which is pretty significant. We're going from an unlevered beta of 0.9 to 1.63 compared to the market beta of 1.38. So by doing the bottom-up beta with a debt to equity adjustment, we actually do end up with a higher risk premium than otherwise we might have had. The market value of the debt does come down a little bit as a result of the long maturity, though, which is kind of nice for them. It goes from closer to 17 billion to about 16.5 billion, and their weighted average cost of capital comes down to like 6% as a result of that. But either way, the cost of equity is relatively high. Part of the reason that this is probably off because we haven't adjusted any of our future debt to equity ratios or anything. So again, don't pay any attention to that, but I was kind of curious to see where our cost of equity was at this point. Like their interest payments are rational, and 20% average tax rate over the last 3 years, that's also pretty reasonable. About 12% margin, that's pretty reasonable. That was kind of close to what our industry grouping was, I believe. Yeah, 12%. 3.11 was the sales to capital we expected. Ooh, and their sales to capital is abysmal. Oof. That is rough, buddy. Not very good. Not very good. But we'll get to that when we get to that. I mean, it might be fine. It may not necessarily affect them in an overly negative way, but that's definitely not a very impressive one.
I will, however, provide you with the PPA impact each quarter, as well as point out key noteworthy items to help calculate an adjusted EPS number to the extent helpful. For the first quarter, PPA was 32 cents per share.
Yeah, I'll be back in like half a second.
We have roughly a positive $40 million year-over-year impact on revenues and around a negative $25 million year-over-year impact on EBITDA in 2021, reflecting the strengthening of the dollar and sterling since the start of the year. We are operating on strong footing, evidenced by a rapidly growing direct-to-consumer business and a resilient core linear business. And our ability to convert EBITDA to free cash flow, where I continue to see at least 50% this year, has never been more valuable given reinvestment demands. We have a self-funded business aimed at supporting an immense global direct-to-consumer opportunity. We couldn't be more excited as a management team to focus on continuing to deliver solid operating performance while we build the framework to support long-term sustainable growth and shareholder value. I'd like to turn it over to the operator to start taking questions.
Ladies and gentlemen, to ask a question, please press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Your first question comes from Robert Fishman with MoffettNathanson. Your line is open.
Full year core U.S. affiliate fee growth after excluding next-gen revenues, so for the full year. And then more broadly, have you seen any pushback from launching Discovery Plus in domestic affiliate fee negotiations? And maybe if you can talk to whether the launch of Discovery Plus on Xfinity should be viewed as incremental or cannibalistic to your overall partnership with Comcast. Thank you.
Okay, so good morning. Let me start with that last question. We're super excited about the upcoming launches here. As you have seen in our numbers, if you do the math, we've been adding about 1.5 million subscribers on a monthly basis over the past 2 months here. And I do want to point out that these numbers are going to be moving around a little, but the Comcast launch is going to be one very positive event. And to answer your question, I do think there is a significant incremental impact. That's what we've seen with other deals coming online after launch. So that should be a positive. And we also look at other events happening internationally over the next couple of months that should further support the subscriber growth here. Most importantly, obviously, the Olympics coming in internationally. So that's for the subscriber trend here. To your other question on the U.S. affiliate side, again, as I just laid out, we're super happy with what we're seeing for distribution across the entire ecosystem here. Clearly seeing very healthy and accelerating contributions from Discovery Plus and our D2C efforts overall, but we're also looking at a very healthy underlying trend in the core business. You saw the linear subscriber numbers, which have again been a little better than maybe over the average of the past 18 months or so, with only 2% down in our
All right, I'm back. Sorry about that.
As I said, we continue to enjoy roughly mid-single-digit growth here in the linear part of the ecosystem. Your question about renewals and impact of Discovery Plus. Look, as I said, we are continuing to get fee increases. That's one of the reasons we have been able to continue the growth that we have delivered in the fourth quarter, now in the first quarter. And we have been seeing very positive discussions for the past renewals and for upcoming renewals as well.
Not really related to Discovery, but I was realized I hadn't actually checked the news to see whether or not a certain announcement was made related to one of my other stocks.
Of viewership for our affiliates. We're a great partner. We're leaning in with investments. This company is investing as much in content as never before this year. And we're doing that, and we're making that available.
Remembered that today I was waiting on a certain FDA approval of a certain drug in relation to one of my holdings. Turns out it was approved, and now that stock just soared today, so that's pretty cool. Nothing like seeing a pretty significant holding of yours jump 35% in a day. Anyway, back to Discovery.
The only thing I would add to that is that outside the U.S., we've been doing real partnership arrangements, whether it be
Go check out my Biogen valuation if you want more information on that.
And the fact that Comcast, Brian is a great operator. He's launched us on Flex. We're now going to be launching on X1. So we really, effectively, we have two sides of a terrific partnership. They're getting value in, and we're talking to a number of other distributors that will be following on. But it's not cannibalistic at all with Comcast. They're able to create value for us and for them by, and I think they have some real entitlement. They're a broadband leader, and these channel stores have really developed. And Comcast is looking. And between Flex and X1, it could be a real generator of value for both of us. And as Gunnar said, the share of our traditional channels are going up. They're selling those channels. The cost of those channels are very low. And we're probably the best actor in that space in that we're providing the core value of the bundle. And we have renewed some deals since we launched Discovery Plus, and we've done very well.
And I just realized I forgot to answer part of the question. We're not giving a full year, affiliate growth outlook here for all the known reasons. But what I did say a little earlier is some color on the second quarter. And let me maybe elaborate on that. So again, we delivered 12% in Q1, and I expect an acceleration off of this number. I'm not getting more specific here because to some extent it is going to depend on the cadence of subscriber additions on the D2C side, because as I said, that's flowing through now very significantly on the revenue side. But if you keep in mind, last year in Q2 we had a very sizable one-off item, so that's going to work against us here. And when I say acceleration from the 12%, I mean despite that one-off. So on an underlying basis, we'll see. This may be an underlying high single-digit growth quarter, which is going to come through as high teens growth quarter, which is going to come through as an acceleration against the 12%.
Thank you, Doug.
Your next question comes from Doug Mitchelson with Credit Suisse. Your line is open.
Thanks so much. Kind of hard to fill in the questions here. I think David, first for you, how are you balancing content on Go versus Discovery Plus? How are you and versus the linear networks and any change in content strategy from what you've seen so far in terms of what people are consuming on Discovery Plus? I think that's sort of number one. I think number two, upfront looks like up 15 to 20% for CPM. year over year. It's early. We've got a ways to go, but, the setup looks, very, very strong. Any thoughts for Discovery and comments on that? And if I could tag on a quick one, ad load at 4 minutes, when does that start increasing, or do you just leave it at 4 minutes because it's good enough? Thanks so much.
Thanks, Doug. On the upfront, look, I don't know that I've seen 50% increases in CPMs off of a prior year upfront before. The CPMs are very high. But what we really have an advantage of is that the broadcasters have been getting $60 plus, and we've been getting less than half that. And now all of a sudden, instead of being we're booking we're really making progress and booking significant dollars in the 40s, high 40s, even $50. And part of that has to do with the fact that our share is going up. We have some hit shows, whether it be male on Discovery or whether it be shows like 90 Day Fiance, which is #1 show on television. And we've started to get paid a lot more money for that. And so I think you will see our CPMs, I think, meaningfully better because we have a lot of headroom still to drive our CPM versus competitors that have been at a very high level. So I think we hit this up front at a very good moment. In addition, we have now some scale inventory on Discovery Plus, which is selling very well. And in that environment and on Go, we don't have the disadvantage of it's a viewer is a viewer. So we don't have that inherent disadvantage versus the broadcaster. So we're getting paid on every sub, and we also have a very good demographic, which is generating dramatically higher CPMs than we're seeing in traditional. So overall, I think the advertising market very, very strong. Upfront coming up, feeling good about it. In terms of balancing, the idea that we have viewing subs on Discovery Plus spending over 3 hours, and that we have the highest ratings, and that our churn is extremely low, is telling us a lot about the quality of this product. But what's really interesting is that the top shows, our top original shows and top shows from our channels, are only generating about 10% of the viewership. We have a very long tail library about the size of Netflix, and people are spending a lot of time with it, and a lot of time. So we don't have the one hit show or the one hit movie. But I think as a result of that, we're seeing much lower churn than our peers, and usage that is
top shows
more. And that's generating
only being about 10% of their viewership. That is actually pretty impressive compared to some of the other streaming services.
We will continue to experiment with how
that does suggest a rather broad-based viewership comparatively. Like, it may not be a very high amount of viewership relative to some of the top players, but that would suggest that the subscribers they do have are actually like fans, actual committed fans to the service.
Look, we're continuing to obviously
to the service, not to a specific show. It's great.
Our power outside the U.S. is this combination.
It'd be really great if they could get some good flagships in there, which obviously the combination with Warner Bros. Will help with that, because Warner Bros. Has a lot more like flagship type material.
And so we're continuing to lean into that. We are seeing, obviously, a lot of that great content. People, and the success we've had to date in the markets, knowing that obviously since we launched and started talking about Discovery Plus's success over the last few months, we've launched in no really new.
But they're not even talking about that in this call, because this call and the last call we listened to are both pre the announcement of the merger. So.
A exploitation of the content we are investing in, windowing in some cases earlier on Discovery Plus, and then getting a sort of second fund later on either our free-to-air or our pay nets, and in some cases, obviously, some content exclusively on Discovery Plus. And that combination of content mix is working extremely well for us, and is one that we're continuing to look at the data and the response of the consumer and continue to modify and adjust as necessary. The only other thing I'd say, Dave, to the question also about the 4 minutes of advertising, we obviously market the service as 5, and so we came out with a lower ad load than even what we marketed. We're going to continue to stay at that low for now, but that actually over time, when we think it's appropriate, which we don't have any plans to do that for the minute, but down the road, we obviously have some flexibility to move above the 4 minutes if we need.
And then, Daggett, maybe if I can just add to that, it's an upside, but right now, I mean, the trends are so overwhelmingly positive. I mean, we have so much opportunity without having to, fiddle with the consumer experience here, right? And as we said, we're already tracking, north of $10 ARPU for that headlight product. And as you would imagine, there's been a positive trend over the course of the quarter as we have sort of, fired up the subscriber base and attracted more advertisers into the product. So there is an underlying positive dynamic. But if you just take a step back here, why are we so excited about this? Number one, we've ceased to just sell commercial demo. It's a big difference between the linear TV and our digital platform here. We're selling every single eyeball on Discovery Plus and TV Everywhere for that matter. Number two is we've got a really level playing field here. That big gap between broadcast and cable CPMs that we've been discussing and seeing for decades here just doesn't exist. It's premium online video, and we're getting full value for our products. Not only that, we have a highly engaged audience. You heard some of the stats that we mentioned that are probably top of the industry. Very family-friendly content environment. Couple that with the fact that premium online video inventory is scarce in the first place because a lot of the viewership is happening on ad-free platforms. That drives super high demand and a hot market environment right now. The other thing that I want to make, the other point I want to make here in terms of upsides is we're still in the early innings from the perspective of our product offerings towards advertisers. Right? We have just launched our binge advertising products, pause ads. We're working on more, and it's in a way it's part of the prioritization exercise here to get all those features online. But there are a couple of great other ideas. So I do think that we will, without even playing with the number of minutes here, we will have a pretty positive run rate here for ARPU over the next couple of months.
All right, thank you all very much.
Our next question comes from Kutgun Maral with RBC Capital Markets. Your line is open.
Good morning. Thank you for taking the questions. Two, if I could. First, on the international pay TV ecosystem, one of your peers recently announced plans to shutter a number of its networks across parts of Asia to focus even more on DTC. On your end, can you refresh us on what linear TV, pay TV subscriber trends you're seeing across your larger international markets, and ultimately your comfort level in the sustainability of those trends compared to perhaps maybe more drastically pivoting towards streaming? And then I have a follow-up.
On the international question, in terms of pay TV universe, we're continuing to see a kind of stable to up slightly universe across the world. We have seen, which we've been seeing actually for years, it's not necessarily a new trend. Unlike in the U.S., we have seen more of a churn down from some of the higher end tiers, but more of a cord shaving in a few markets, and much less of a cord cutting. And so universe-wise, we feel like it continues to be fairly stable. There are some, again, it's hard to talk about the international markets in a broad strokes, but there are select markets which are seeing obviously more challenges. Brazil has been one where we've seen more of subscriber decline as the middle class there has been hit harder over the last few years. But overall, the universe remains fairly stable, and the outlook for it for us continues to be that it will remain pretty stable with, again, some pockets of different markets moving in different directions, but net reasonable stability with some continued churn down from the higher, more broadly packaged tiers down to a slightly lower price tiers in some markets. And I think as it relates to the Disney news about their shuttering of the Asian channels, look, I think we've obviously leaned in, not to say we haven't shut full portfolios of channels, but as we've talked to you before, selectively in markets where we think the long-term opportunity of what is possible with Discovery Plus and the ARPUs that Gunnar and David talked to, where there's an advantage there, we've leaned into that in select markets like we've talked to you about in Denmark and other places. And we'll continue to look at that. As Discovery Plus rolls out in more markets internationally, obviously that opportunity will become more real and is something we'll evaluate on a case-by-case and a market-by-market basis.
But, for us, The market feels right now very strong for us. We're growing both our ad revenue and affiliate revenue. Our ad revenue is growing dramatically, but it also gives us a relationship with every distributor. And what we're able to do is provide a value to the distributor in the bundle, where in many cases pay TV is only 20-30% penetrated. And then they're super with us on Discovery Plus and saying, let's reach the rest of the universe. So the markets tend to look very different. And so the idea of supporting us with Discovery Plus and on our traditional platform is something that just has a lot of symmetry outside the U.S. Plus, we have the ability to promote on our platforms. So, and we have a massive library. So for us right now, having this generating a lot of free cash flow and growth in our traditional, maintaining and strengthening our existing relationships, and they don't want the channel stores to take all the business. So they're coming to us and saying, Discovery Plus is terrific. That's good for us. It's good for you. How do we help? And that's whether it's the mobile players or the broadband players. So for us, we think we can play. It's an advantage for us.
That's great.
Remember, we have 10 to 12 channels in each country, so the scale is bigger.
That's great. Thank you. And if I could for Gunnar, maybe I want to just maybe take a step back from the quarter and ask about the OIBDA outlook over the next few years. Obviously, 2020 took a hit with COVID, and this year we're seeing peak DTC investments as well as Olympics weighing on profitability. Looking ahead, though, the DTC losses ease, Olympics losses get better in 2022 and then in 2023, and of course, hopefully through all this we'll hopefully see a recovery in linear ad trends and revenue as well. I'm of course not expecting specific guidance, but can you just help us think through any high-level puts and takes as we think about what seems like a very favorable setup?
Well, I think you've just done that. I think those are the right building blocks. And look, I mean, just giving you a little more color. As I said before, we have stayed away from giving you very specific guidance to break even, et cetera. I continue to be super happy with the metrics that we're seeing for D+. And as I said a minute ago, in December we put out there this 20% margin bogey for sort of the D+ business at scale. That's looking incredibly conservative based on what we're seeing right now. I mean, let me just sort of take a step back here. We roll to pay numbers, which are top of the industry. Churn rate, and again, I want to be careful here because it's so early days, but the cohort numbers are looking extremely compelling. And we're doing better on Arpu than we originally modeled. Take those three together, that just leads to a customer lifetime value estimate right now, and I want to be specific. It's still an estimate, but it's significantly better than what we had in mind when we gave that number in December. At the same time, we're acquiring these subs at pretty efficient subscriber acquisition costs. In fact, a lot of the loss that we're looking at here for startup investments in the quarter is essentially the vast majority of this is just marketing driven, and you would assume some efficiency as the product becomes grows in awareness, as we start getting more word of mouth, et cetera, and as we're benefiting from the high retention that we're seeing in our subscriber base. So taking all that together, again, it's just too early to start talking about sort of an updated margin profile for 3, 4, 5 years out. But we feel very, very good about it. And sort of this point about break even, again, as we said before, it's not a metric we manage towards. As long as I can acquire subscribers here with phenomenal lifetime value, but a fraction of that, a fraction of cost of that lifetime value, we'll do it. And we also stand by what we said earlier. I don't think anyone is going to have the margins that we will have in this business, and I think we're going to get there get to break even or scaled margins much earlier than anyone else, just because our fundamental underlying economics are not changing. We're getting the same value from the consumer, and we're getting the same leverage out of our content. We continue to be in super efficient verticals that we're super strong in, and that we have 30 years of experience in, and we continue to exploit our content across platforms and across the entire
globe. And it's amazing to see how this model, again, it's early days, but how it's working. We're getting phenomenal cross-pollination between our TV Everywhere environment and Discovery Plus. It's great, and we'll just have to. That's why I decided to give you a couple more KPIs, so you can all sort of make up your minds and think about it. How does it compare to what you're hearing from others? What does the model look like? And we'll just keep giving you some transparency here and take it from there, rather than giving you a long-term 5-year outlook or so.
That's great. Thank you all.
Your next question comes from Alexia Quadrani with JP Morgan. Your line is open.
Thank you. Can you just please elaborate a little bit more on the demo of the typical consumer and your Discovery Plus? It sounds like you're skewing favorably toward the demo that advertisers are particularly excited about.
All right, we're going to do 2 more years.
I'm wondering if, given your outside
and
success
we'll call it good.
in the ad light option, if you're skewing your promotional activity, more toward that option versus the ad-free. And then my second question is just really, on the moderation of linear sub decline that we've seen. You've got such great insight into the industry, and I'm curious. I know you don't have a crystal ball, but I'm curious if you think, what's really been driving it and how sustainable it is.
Sure. Thanks, Alexia. It's a lot younger, more than about 15 years younger, and it's also about half of people that have cable and about half of people that don't have cable. And the advertisers are and also with the length of view so high and the engagement so high, we've been doing extremely well. To your point, we look at Ad Light as kind of a breakout hit. Here we are, trending right now well over $10, and as we get bigger, it's continuing to grow, and we have this strong demo. So we look at Ad Light as something that, as we look at ad-free versus Ad Light, we've been talking to those customers, and at 4 minutes an hour, they seem very happy. The ad-free are very happy, but we don't really see a difference, and the ability to generate significant incremental economics off of the Ad Light. So you'll see us pushing on Ad Light. And in the ad-free, which was very inexpensive as we were going to be rolling it out outside the U.S., the ability to do an Ad Light outside the U.S., JB and I, after seeing this data, immediately 2 months ago were wow. And so we've been pivoting because there could be upwards of 50% incremental revenue. And as we get to scale more than that by doing the Ad Light, and you have a very good customer experience, which was a surprise to us. We really thought people are used to commercials, they're not going to want any, but it's one of the reasons we're not going to 5. They're so happy with the 4, and we're getting such a premium for it.
Sorry about that.
And it's working so well, we're just going to ride it.
And Alexia, maybe on your other question, the moderation of sub losses in linear, I wouldn't want to comment on the overall industry trend. Just keep in mind our better number here is very much a Discovery specific result. We're getting additional carriage in some of the renewals of last year, and that's helped us, and we obviously continue to be among the best distributed across the virtual MVPD space. So that's been those two have been the helpers.
And for most of our core services, for all of our core services, we have very protected carriage as well. So the ability to, I don't think they would want to do anything to us, but we have very protected carriage in terms of being on the tiers and not being able to be moved around at all. So you should continue to see us, by the very nature of our agreements, be at the very top, and the fact that they could add our channels to tiers to drive viewership, which we've seen in some of our newer deals, that we'll probably do better.
Thank you very much.
Your next question comes from Rich Greenfield with Lightshed Partners. Your line is open.
Hi, thanks for taking the question. David, I think you said earlier that Discovery Plus users are spending 3 hours a day. That would be, yep, can you hear me?
Yeah, now we can.
Sorry, I don't know what happened. So, David, I think you said before a couple of times that time spent per Discovery Plus user is like 3 hours plus per day. that would be like 50% higher than Netflix, and I think maybe 15 times higher than Peacock daily usage. Just want to make sure, is that across the mean? Is that looking at 15 million subscribers and saying they're averaging 3 hours per day, or is that some subset of the 15 million? And then I have a follow-up on ad sales. I think when you were talking about, at least in the release, you were talking about how sort of the reach of the pay TV universe had an impact on ad sales. Could you just maybe explain what's happening in terms of, is the shrinking pay TV universe pushing more towards things like Discovery Plus and digital? What exactly was the reason of that comment, and how do you think that comment plays out over the coming 12, 24 months?
Okay, thank you, Rich. Let me clarify that. The 3 hours per day are per viewing sub, so not per average sub. And you can assume that we have about a close to 50%
in my lap right now.
Subscriber base on the
make me sneeze a bunch.
So that's how you need to interpret that number. Again, I think you're right though. It's a great statistic across the ecosystem, and we're super excited about it. The point about the universe shrinking, it's just, as I laid out, we gained share, and by the way, both domestically and internationally, across the first quarter. And the viewing trends though for the entire pay TV ecosystem in the first quarter just have been tough. We've seen universe estimates declines and people using television.
The thing is that we were up significantly during the pandemic, and we were able to produce content, and we were really able to grow share pretty significantly everywhere in the world. Some of our channels like TLC and Discovery and HGTV, they don't have the same cycle that scripted does, but we weren't able to produce a lot of content for those. We're now back to about 90 or 95%, and you'll be seeing more of our fresh content coming in. So one, I think on a CAGR basis, we look different than everybody because we were up meaningfully during this period. But two, we're going to have more content because it took us a little while with some of the fixer-uppers we had some of the impact of the pandemic, but we're now 90 plus back, and you'll see more fresh content, and I think we'll continue to gain share and outperform.
And David, just because as a kind of a big picture question for you.
It's pretty interesting hearing them make those comments, especially since this is their first quarter call, and they made the announcement of the merger like a month later. So it's like I feel like it's they know in this call, and so it's like they're kind of like trying to talk about it without talking about it.
Look, we're learning a lot. We had a ton of originals, and we could see
like, oh yeah, we're gonna have more content because we're about to purchase a huge amount of it.
we have it's pretty fluid. We have higher production values. We've spent a little bit more star power on Discovery Plus. We're trying to figure out what is the plus. Fixer Upper, we didn't, and Chip and Jo, we haven't put anywhere except for Discovery Plus. That was a big helper to us. The BBC content will only be on Discovery Plus. We're experimenting with, we put a 90-day series on that only went on Discovery Plus, and it drove a lot of subscribers and a lot of viewership. And then those viewers are watching our whole 90-day library with over 150 hours of original on there. So we're trying to, and then at some point, do we put that back on, some of that content back? That's what we're trying to figure out right now. But we've been able to feed the growth. As Gunnar said, we're seeing some steady and strong growth on Discovery Plus, and we're really focused on growing in
yeah, so their retained earnings is pretty good. That's good to see over the long run.
It's a little bit of a different story because
it doesn't necessarily matter, but it is a good, healthy sign.
The international piece of that.
It's like they had to dip down a little bit in it when they made their large acquisition, but that's good. Which means, like, for example, you'll probably see another dip down in it after they make the acquisition in the next year. But that's fine. It's for good reasons, and it seems like they have a strong enough cash flow pool to build it back up.
Exist in scripted, which for the price tag you can only
do
one or the other.
Last year we're gonna do, then we'll do some actual analysis.
We are for franchises and talent that are known to our linear brands. We continue to make sure that we're nurturing those audiences. And selectively, and particularly as David said, we're experimenting in different ways to try and see what the data tells us. We're experimenting with some early windows or having a talent that's been doing stuff on linear do some additional stuff for us on D2C. But we can do a little bit of both. We continue to produce great originals and stories for our traditional television and give people an ability who want to access that and who aren't subscribing to it on in the bigger bundles, access to it on D+, either concurrently or even a bit later in some cases. And at the same time, invest in some originals for Discovery Plus that are unique, new IP, new faces, new talent, new stories, edgier stories in some cases than what we could do on linear traditionally, and without breaking the bank on content budgets. And so it's another strength of our unique content model that doesn't make it such an either or, and we're continuing to experiment with some of the windows and see what the data tells us.
The only point I would add is the reason I talked about in my comments about Italy is 80% of that country, all of our content is new to them. So as you look across Europe and Latin America, even though we have a very successful pay and business, we have a huge library, having been in these markets locally for 15, 20 years, that we could now go to an offering at a very low price and be available to 80% of the country that didn't have access to us before. So here of how do we window it and how do we move it back and forth is a very different question when you're going into a country that's 20 or 30% penetration, and it's now new to the overwhelming majority of the population. They've heard of it, they have good feeling about it, but maybe they couldn't afford to buy it, or they want it on a different device, but it's a different calculation.
But David, it's most extreme in some of those international territories, but to some extent we see the same here domestically. As we laid out, for the first time, we're now targeting 30 million homes that don't have a cable subscription anymore. We're getting a significant number of additional viewers in here that are generating revenue at the same or better ARPU, and that allows us to invest behind this. And that investment, over a couple of months or next year maybe is going to raise all boats, because we're just creating more of what we're best at, which is our global, unencumbered, 100% owned, high quality IP.
Okay, and your next question comes from Brandon Nispel with the bank. Your line is open.
Hey, thank you for taking the question. Gunnar, I was hoping you could talk more about the retention curves that you're seeing thus far for the cohort of customers. Are you seeing retentions after the first month of greater, less than 90%? Maybe just some more color there would be helpful. Thank you.
Yeah, look, as I said before, we're very, very encouraged by those retention curves. We are seeing more than 90% retentions. We're starting one step earlier, very, very strong roll to pay of north of 80% after the 7-day free trial, talking US here, and then greater than 90% retention in the first month, and then a very, very significant drop off in sort of cohort churn. So again, it's way too early to talk about sort of a stable a long-term churn rate here, but the numbers are off the charts compared with what we expected, and also, frankly, based on the intel that we have been able to pull together here, I think they're also stacking up very, very nicely against competitive offerings. Again, it's early days. I always want to disclaim that, but we could not be happier. And I think it makes sense if you look at the length of tune that we've always been seeing with our viewership in linear as well. We're essentially saying the same. We're seeing the same behaviors here in the D2C world.
Then on long-term churn expectations, where do you think you fall? You said low single digits, but is that 2 to 3%, or is that more of a 4% number? Thank you.
Well, look, let's. As I said, it would be speculation right now. I think we're going to do very, very well compared with even the leading players in the industry.
It's tough for us to take 1 month, or 2 months, or 3 months, and say this is where it's going to be forever. The numbers are very good, and we are in the low single. and we'll see over the next, even if we think it's trending, down. If we think that that may change, over the next couple of months, for the good or the bad. But right now, by every measure, the churn is significantly lower than we expected, and it's one of the reasons why we're leaning into it. Not just the length of view, but the very low churn, and how happy people seem to be with the product.
And I mean, again, what we're looking at right now is really that estimating customer lifetime value up very, very significantly compared to what we put in our initial business case. That was the foundation of what we presented in December, and how that relates to subscriber acquisition costs. And clearly, if we're looking at our numbers here, I had to greenlight a lot of marketing spend in the first quarter, and I was very, very happy to do it, because we're just looking at even the revenue contributions over the balance of the year. It's just an amazing return on investment by any measure.
Thanks for taking the questions.
Your last question comes from Ben Swinburne with Morgan Stanley. Your line is open.
Thanks. Good morning, everybody. Gunnar, I was wondering if you could talk a little bit about how you guys think about the D2C business in the context of the overall business. In other words, do you think about this as a single P&L? Because it's very tempting on our side to hear sort of the $1 billion drag on EBITDA and the path to break even as suggesting some pretty substantial EBITDA growth for the company over the next several years. And I'm wondering if you can talk a little bit about how you think about managing the business, particularly on the content and marketing front, so our expectations are sort of in the right place, if that makes sense.
Have one moment.
I mean, the question is spot on, Ben, because I mean, fact of the matter is we're looking at two, at least revenue streams here now that have fundamentally different, financial profile.
Okay, I'm back. Just want to get one more soda before we crack into the analysis.
Digital business and a linear business. This is not the reality right now, and maybe less so than for others, just because we have that
done putting the numbers in.
IP exploitation model. One of the big advantages that we have.
We're not going to listen to that call today. We'll listen to that when we do the combination grouping.
Footprint and across platforms. So that's why right now it is a little hard to really cleanly split out a digital P&L and a linear P&L. And frankly, it's also not entirely in line with how we manage the company, because JB and his team.
Shareholders' equity has grown over time in general, as has the retained earnings, which is good. All while they've been increasing their share buybacks, and so the fact that they've been able to balance between the two things is pretty great.
Linear and digital. That being said, we will try to make it as easy as possible.
The debt levels have significantly increased during that time frame, but as I said, they've managed to power through their retained earnings regardless of that, so that's pretty all right. Current liabilities have remained relatively under control. They went down pretty significantly and then back up, but they've also been coming back down again. So I'd say that the working capital part of the liabilities has been pretty functional, regardless of the long-term debt coming up pretty significantly. But in terms of that, their current assets have been moving consistently upward over time, so that's pretty good to see, as well as the overall total assets have also gone up over time pretty significantly. In general, their total assets have come up not quite as fast as their total liabilities, but they still have a pretty strong buffer.
Of that financial profile. And as I said, I mean, I am focused on long-term.
Invested capital decreased pretty significantly, but then bounced back a decent bit. Overall, the average seems pretty decent over time.
Accelerating U.S.
relatively stable.
Revenues from 12% against a tough comp. Double-digit U.S. ad sales growth.
Come down a little bit over this entire time frame, but not majorly so.
Acceleration in international distribution growth to mid-single digits. I think, again, it's early days, but I would say it's working.
Good on them. They've consistently been doing share buybacks with a small, exception there. But overall, that's been significantly lower than their free cash flow to equity, which means they haven't been overpaying the shareholders. It's always good to see that they're not paying their shareholders at the expense of the function of the company. Stop. They have been issuing debt pretty consistently over this time frame, like I said, but because of the fact that it's not coming at the cost of their overall cash flow, I would argue that it's not issuing debt in order to pay the share buybacks. They've just been able to functionally do both. They've been issuing debt in order to expand the business, but doing share buybacks effectively out of the appropriate earnings, because their earnings definitely covers the buybacks effectively, more than so. While they've done share buybacks pretty consistently, they've also issued new shares whenever they've made larger acquisitions, which is why they actually have more shares now than when at the year where we started. But that's, again, not really a huge big deal. Again, don't pay attention to this yet. We're not done. I'm comfortable using the 3-year average of their sales to capital as the base year of 0.41. That does make sense relative to overall. It looks like their sales to capital has had up years, but overall it looks like it's been a little bit on a downtrend, but not majorly so. But they're partially transforming their business, so that sort of makes sense. We're going to assume that for our 5-year forward range, that it sort of stays in the area it's been over time. Leaving it at an expected ratio of 0.4. Again, don't pay too much attention to this. Debt to equity, we definitely have to make a huge adjustment for. They do have a pretty significant amount of debt, and they're going to be taking on more debt. Whether or not that's actually a good idea in the long run is definitely up in the air, possibly questionable, but we'll see where that all plays out. I think I'm pretty pleased with leaving debt to equity ratio in this range here. That's probably what it'll be for the pro forma, but in this particular one, we're looking at what it looks like if they didn't make the deal. So that's something we sort of have to keep in mind as we're doing this, is that we know that the merger is happening with Discovery, but for this particular evaluation that I'm doing today, we're acting as though there is no merger and we have no idea about that whatsoever. This is a pre-merger evaluation, and then I'll do a second video at some point in the future where we do a pro forma evaluation where we take those things into account. But we're not doing that here today, so no need to think about those things too specifically. Stop. Market expects earnings growth of 10% or so per year for the next 5 years. You're already looking at the analyst expectations. For the next 2 years of revenue growth, they were expecting 13.1% and 4.8%. And I'm already aware that was roughly in line with where it was prior to the merger discussion. So I don't really think it's been updated much here. But we'll double check that with here because Zacks tends to update these things a little bit slower, though they have a smaller amount of analysts here. But as you can see, it's roughly the same. It's not really a huge difference. So I don't think they've really taken those things into account. They're probably not going to until the deal has been agreed to by the SEC. And they also have a roughly similar earnings expectation as well. As you can see, the short-term pricing based off of fundamental analysis and applying that to multiples, the market seems to believe that Discovery should be worth about 52%, which is like 66% higher than it is, and it's pretty consistent across the board. Communications companies in general have been trading at relatively low multiples comparative to the market for some time now, partially because of the general excitement around Netflix and the fact that all the other communication companies have been thought to be essentially going out of business relative to them. That sort of makes sense. If we assume that the analysts' expectations of revenue growth are relatively accurate, and we also assume that they go into steady state after those 2 years of projected earnings or projected revenue growth, well then that would give them a 5-year CAGR of about 4.47%. So we'll just go ahead and throw 4.5 on there as the analyst number, and we'll probably put that roughly in line with what our middle point is. I don't really want to make too bold of predictions myself, so we sort of assume maybe 10% on the high end, putting it on there, and then maybe negative 1% on the low end on the assumption that maybe it's just not very successful, and that gives you about a middle point of basically the same level. So I'm pretty comfortable with putting that as our revenue CAGRs. As far as the distribution, how do I feel about this? I would say I feel pretty uncertain about which direction all of that could go, but not necessarily in a pessimistic or optimistic way. So I'm probably just going to spread out the middle a little bit further in both directions. I do think the negative 1% and the 10% are not super likely, so I'm going to leave that all at 5%. But between these three outcomes, it definitely makes, I definitely think I could pretty reasonably see that that would have been a logical path either way. It's like you look at their growth over time. I mean, they've had a pretty significant growth in revenues, but obviously that comes partially on the back of the acquisitions that they've made. But they've been able to hold their ground pretty significantly. And as we said before, their earnings have been pretty consistent over that time frame as well. The market seems to believe that they were going to grow their earnings pretty significantly, but that part I feel is less easy to see. But it's also worth noting that that takes into account buybacks. The analyst number is an EPS growth, not an income growth. And so you have to take that into account. So while we have 10.35 here for the analyst number, it's probably overstated because they probably would be including buybacks. So maybe 12% would probably be better in that time frame. Maybe 13% perhaps. Yeah, it's probably a little bit better. They're 11.87% right now as far as their margin. Over the long run, 12% still about the same. We're going to have to put that might be maybe overstating it a little bit on the low end. Maybe not. It might be about as good as I'm willing to give them. Alright, so let's adjust for the default risk. And then that should be about it. All right. I do think that's pretty much it. The things I want to adjust first. All right, yeah. I think I'm pretty pleased with that. Ticker DISCA, Class A Discovery Communications. U.S. Treasury is 1.56 at this point. Equity risk premium that I have is 4.82. The discount rate that I come up with for them after adjusting for their industry and debt risk profile comes up to 10%. Funny that it's like that exactly. They have no dividend. 5 years ago, they had sales of $6.39 or so billion, and the most recent year is $10.6 billion, growing their sales at about 10.79% per year. Sales to capital ratio of 0.41, incredibly low relative to what we'd expect out of their industry. Sales or returns on invested capital of 7.62% with a relatively high debt to equity ratio of 105%. Relatively normal risk default expectations that we would have in terms of what they've currently had in the most recent past. Adjusted profit margins of close to 12%, which is actually in line with what we would expect out of their industry, with giving them a profit of $1.2 billion in the most recent year. They're currently trading at 31.24. Our probability distribution for them, we have spread out a little bit, and it's relatively flattened compared to the more normal distribution that we have, giving about pretty much an equal expectation between the second and fourth models overall. As far as the revenue expectations we have for them, in 5 years, we would expect anywhere from $10.1 billion to possibly up to $17.1 to $17.2 billion, with an expected revenue of about $13.3 billion, which would give them revenue growth of 4.5% per year for the next 5 years, and a sales to capital ratio that we assume might actually climb ever so slightly to 0.43 to put them back where they were a couple years ago. Returns on invested capital would drop to about 5.66% on a distributed basis, and we have a distributed debt to equity ratio of about 104%. So we're assuming that basically they stay about the same because we're not sure what they might otherwise have done. Because again, this valuation is meant to be taken in terms of assuming that the merger wasn't going to happen. So this is meant to be pre-merger thoughts on Discovery, and we'll do a separate valuation on them post-merger, just so everyone's clear when paying attention to this. This is pre-merger Discovery. We're not taking anything about that into account. We're assuming we don't know anything about that. Based off that, anyway, continuing, the default expectations we would have for them is about 1.5% per year for the next 5 years, which isn't terribly high, but it could be lower. And so we assume that the profit margins would stay roughly where they were at, but perhaps even climbing ever so slightly to about 12.15%. And we would expect in 5 years that they would have an adjusted profit of about $1.6 billion, which with the discount rate that we use comes to about $25.50 for their present value, which puts them a little over 18% overvalued. The 5-year forward targets unadjusted for dividends, which isn't really relevant, they don't have a dividend, comes to anywhere between $12.26 a share to possibly up to $92.32 a share, and on a distributed basis we would expect it to be about $41.07, which means we would expect them to get over the next 5 years about 5.62% per year, which compared to the discount rate that we use for them is not very impressive. It's also not even that impressive compared to the expected market return that we have at this point, which right now the expected market return is 6.375%. So it's lower than the market return we expect and lower than the expected return that they ought to have based off the risk profile. So not very good returns for Discovery. We're doing this, as we said, in tandem with the at&t valuation that I already had pre-merger, which their at&t returns were higher pre-merger than this, though not terribly so. I think it was like 9% or so. And then we've already done our post-merger valuation for at&t, which actually increased the valuation by like 1%. So now it's like closer to 11% of an expected return for at&t, assuming that the merger and spinoff in their case goes through. So in Discovery's case, pre-merger, they don't actually look that appealing to me. The short-term pricing metrics does make it look very appealing, which could explain why so many other investors are very, very interested in Discovery. Is that on a first glance basis, there's a lot of reason to believe that Discovery could be a very appealing investment because of multiples, but we don't do this based off multiples. We do it based off of discounted cash flows, and the discounted cash flows tell us that we can only expect about 5.62% for them. But like I said, at some point in the near future, we'll do another overview of Discovery, taking the merger into account, which would adjust a lot of things. It would adjust our revenue expectations, it would adjust our sales to capital expectations, it would adjust our debt to equity expectations, and it might adjust our profit expectations as well. And then all those things together would affect the returns on invested capital, as well as the discount rate, as well as the default risk. And so we very well might come up with a higher expected return for the next 5 years if we do that, but who's to say at this point? So either way, that's it that we're going to do for today. This has been Live Valuation. I'm Midas Moriarty. Please subscribe to the channel if you enjoy in-depth valuation content like this. We stream 3 times a week, most weeks, assuming I'm not sick like I sort of am today, even though I did decide to stream anyway, though late. But we stream, as I said, 3 times a week on YouTube, Twitch, DLive, Facebook. Please, please, please subscribe to the channel, like the video, comment as well. Your comments, your support, your criticisms, whatever. I take it into account if it's constructive. But either way, join us next time.